We live? I think we are live. So let me get my phone. There's something's going on with the Twitter spaces. So it's called multitasking. I'm multitasking. So yeah. Well, I'm here. I'm here. I'm here. I'm here. There you go. Of course. Yeah, it's just me trading, man. I'm not talking, so I'm just buying, selling some crypto. That's it. No talking until ATC is over. Mic check. So you guys can hear me clearly. That's cool. Yeah, this Monday, like I said, nothing really popping up in the charts, man. I'm just gonna go through some stuff. I need to understand. There you go. Yeah, man. So, like I said earlier, nothing's really popping off. What I've been doing recently, personally, I've been aggressively. Let's see. I've been aggressively moving assets around, right? Just um, basically just selling projects I don't like, keeping ones I do, just changing everything, right? Um, so I'm still in some trades, right? We had, let me see, we had a pump in 70 grand this weekend, and we lost that. It's so weird, like because I trade most on the weekend. Well, for some weird reason, the weekend has been very interesting. We do have a lot more trading happen on the weekend. I'm not sure why exactly. Well, it's very, very strange. Very strange, guys. Let me double check. Oh, yeah. So we're live. We're good. Yeah. So take a look at this chart real quick. This is what's going on here. And let me take a look at this real quick. So this weekend, we broke into 70. It's so weird. I don't know what the hell is going on, man. Like we broke into 70 grand. We just couldn't hold it. Like it was so straight. It was like for like 20, 30 minutes. It was a quick in and a massive, like a very sharp sell-off. So there's a lot of sell orders around 70,500. So that's around, so this is a 1 hour chart. Let me zoom in real quick. So I think we broke this, right? No, this is right here. It's right here. It's around here. This is what we did this weekend. This was the pump that we had into. We hit like 70,000. Holy shit! Wait, that was yesterday. Yeah, so we wicked into 70,900. We wicked into that, and we just went all the way down. We had. It is so strange. The price went to 70,966, and after that we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 straight hours of negative red candles, which is nuts. So there's a massive, absolutely massive sell accumulation in this supply zone. So basically between 70,564 to let me zoom in. 1 second. To 71,594. Because look what happened. 12 straight hours. Because each candle is 1 hour, right? So 12 straight hours of negative price action. Just straight up every hour. Ever since we broke into local high yesterday, 70,000, 9, we just went all the way back down. All the way back down. We wicked as low as I didn't even know we hit 7K, I guess middle of the night. So early today, I guess, earlier today, we hit 67,000. So I think this is like, let me see. We've had difficulty breaking this ever since we lost 70K. This is last week, Monday. We've had difficulty trying to, break past it. Very, very difficult, but we'll kind of see what happens there. We do have a couple of demand zones on the bottom here, but yeah, there's a lot of demand zones on the bottom. But if we lose, this is on the hourly. If we lose 67.6, we're gonna go down to 66. We lose that, we're going as low to 65, 64 on the bottom. Let me go a bit lower. But as of right now, we're just bouncing off between. We're bouncing off. Let me just go down here. Between 66K to 70K. That's the range. So accumulation range between 66K to 70K. And I'm going to check ChatGPT real quick to see what we're doing here. This is on a 4 hour. On the 4 hours, so we're looking at. Let me add another indicator here. 1 second. Let me add another indicator. Supply demand zone. I'm gonna add another one. Supply and demand. Let's see. Supply and demand zones. I'm gonna do price action. I'm looking at something because I want to add on. I'm using one indicator here. There's another one I want to add on to this that gives me more info. So smart order blocks. Yeah, I guess I can use this one. Is that it? There we go. this just gives more information, adds more info onto this, plus the order blocks too. Yeah, man. So like I said, it's a 4 hour chart, very similar to the hourly, but we're basically just harping, guys. I mean, 1 second. I guess. All right. So yeah, this is the 4 hour candle. Same thing, very similar. On the low end demand, we have a strong demand between 64,000 to 66,000, and supply zones between 69 to 71 on the high end. But we'll see what happens. But if we do break below this supply section, also demand section at the bottom here, we're probably going to see 50 something grand, guys. That will be the next drop, the next zone that we're gonna go into. But we'll see. We'll see what happens. Let me go to ChatGPT. I always do this just to give us an analysis on what we're doing here. So what I love this ChatGPT is pretty accurate, because it did say sell the rallies. Every time you get a rally, as long as we're below 75K, expect sell the rally. If you get a rally, which we did on Sunday, which we did on Sunday, I think we did on Friday and on Sunday. Every time we get a rally, it dumps, right? So there's a strong indicator of us going lower, and if we do get a push up, we get a push down. I think it gave us like 65% chance that happens. This was last week when I did this. Let me scan ChatGPT again and see what it shows here. But yeah, so guys, I recommend you guys do this. I love doing this. Is one of the best ways for you to get the a good view on what the market's going to do. Let me use the daily. This is the daily charts right here. I mean, guys, we are in a technically bear market ish, technically. Because this price looks nasty, guys. I mean, you can just see we've been in an uptrend for a while, and just a lot of distribution on the downside. It just feels like we're probably going to accumulate here for a while, guys. I mean, if you look, this is the daily charts. This is on a huge accumulation zone here. So basically 49,000 to 68,000. Yeah, man. So I don't know. We'll see. Like, okay, let me scan this. I'm gonna scan this entire daily charts, and let's see what ChatGPT says. So, so I'm scanning this chart here. This is the daily chart for Bitcoin, and I'm gonna ask it what the hell is going on. What are we doing? All right. So share. So what I'm going to do is this. You could do this for any ticker, stocks, crypto, whatever it is. Just scan your chart or post it in ChatGPT, and just simply ask it. Analyze the charts, and analyze the chart, and tell me where we go from here. Analyze the chart and tell me where we go from here. Assess by percentages, and give me entries and exits. You can ask ChatGPT anything. It scans it for you, tells you what it what. Oh, exactly. No, no emotion. Of course, right? I mean, just whatever. Yeah, so it's gonna. I've been using this strategy for a while now, and it works. There is no doubt this shit fucking works. Because I always go back and look at it. What did ChatGPT tell me to do? It works. So of course, right? I would recommend people definitely you're using these indicators here. I told you guys already. The indicators I use for trading, legit, go to indicators, type in supply and demand, and also type in supply and demand. That's one indicator. And also type in price action concepts or smart money concepts. That's all you need. It to tell you exactly what you need to do. It is amazing. This indicator is absolutely amazing. But I also would ask ChatGPT to give me entries and exits. It does this for 1 hour, 5 minute, 10 minutes, 15 minute, 4 hour, daily, weekly. It breaks everything down. And we'll go through this, ChatGPT's analysis for Bitcoin right now, man. You know what I mean? So, but this stuff works. Yeah, this stuff actually works, man. Guys, give me a second. I'm going to speak real quick again on this guy's show. I'm on two shows right now, guys. So, yeah, yeah, Dave. So it's interesting because I think most people probably fall for this. I'll say probably the older people that aren't, because I mean, young people, I'll say we, man, I'm young, whatever. But young people mostly, they're very, they don't just jump on the first thing they see. You know what I mean? Young people normally, they have less trust. So if they get a message or whatever, they don't really read it. If they get an email or whatever, they don't look at it. Letter in the mail, they don't open it and just kind of throw it away. But this stuff would probably affect a lot of older generation. Probably anyone above 40 or 50 probably would fall for this. But I think the way I've been safe all these years is I don't respond to any messages I get from an email or phone, whatever. I just log into my account, I see what's there, and I move on. I don't open anything. I don't download anything. It is very, very hard in this space to protect the money if you really trust what you see. This happens all the time, right? But I believe the best way to protect yourself, basically question everything, every single thing you see. That's the best way, and I think that's probably the best way. And another way is maybe spread the money around. Don't have all your assets in one place. So even if you do lose your money, it's not all in one location. I mean, it's spread out in multiple wallets or multiple co-wallets, whatever it is. But I just think, just don't trust anything, man. You have to verify before you start clicking or start scanning codes, because this your money. There's nobody to call. There's no bank. There's no customer service. So if your money is gone, it's gone. So you have to be really, really careful before clicking anything you see. Yeah. So yeah, I did. I'm on two shows, so I'm grinding. I'm on a show on Twitter. I'm on YouTube. I'm on Twitter again. I'm on like different shows. So yeah, man. So guys, like I said, I think let's take a look at this. So I scan. You want to do this? I say this all the time. What you want to do? You want to scan the Bitcoin charts, post it, or any charts, any time frame. Post it in ChatGPT. Ask it any question. Analyze this charts. Give me entries and exits. Ask it where we're going, up or down, and it will tell you by percentage. So let's look at this analysis by ChatGPT. Time frames are daily. Yes, a current price 68,700. Structure strong bearish displacement between I'm sorry, strong bearish displacement from 95,000 to 67,000. Currently consolidating above prior demand, which is we are in a we're in a sideways market right now, very sideways, guys. So I don't expect a pump in the market for a while. Whales are accumulating right now. As a matter of fact, I saw a message today on Twitter talking about how Harvard University has sold a large amount of your Bitcoin into Ethereum. Right now, whales are accumulating right now. They're not necessarily, you know, the money's not being made right now, right? Remember, like the way this game is played, the market goes into a downtrend. We could be down for 6 to 8 months. Whales accumulate. They slowly pump the market up. Retail jumps in and they start to sell. That's how this game is played, right? So let's take a look at this. So basically, this is ChatGPT's analysis of the Bitcoin chart right now. Let's take a look at it. Market structure summary: clear lower highs plus clear lower lows, downtrend. Major supply above 75,000 to 78,000, from N to 85,000 to 92,000. So basically, we have major supplies, which means there's a lot of money stacked up in these prices, waiting to short, waiting to sell. So even if the price does go into 75,000 to 78,000, there's a strong chance we are going to go down. So major demand zone from 60,000 to 62,000 and 52,000 to 55,000. So if we do get price goes down, so right now there's a lot of buyers positioned. If the price does go to 60K to 62K, there's a lot of money waiting to go down there, waiting to jump in into those prices, and a big dollar value price waiting to buy at 52 to 55,000. I'm not saying we're gonna go there, but a lot of money, a lot of buy orders are set in that region. That's why a lot of demand zone. That's what prevents the price from going down a lot lower. Because even a lot of buyers are waiting for the price to come down. We don't just crash down to 30K. It doesn't work like that, right? That's what a lot of people, even me, right? I've set buy zones if we do see 50K or 52K. So that's gonna be my biggest buy. If we ever see that, I'm gonna do a large amount of dollar buy, 3x buy on 50K. Hmm? What do you mean? Guys, one second. Let me just give me a second, guys. Yeah. Crucifix Show, what's up? I appreciate you for being here, man. Always supporting, man. Always supporting. Yeah, so let me go back here. Okay, so I'm looking at ChatGPT analysis of the charts here. So let's take a look at this real quick. Real quick. Market structure summary. Okay. Um, we have clear low highs, clear low lows. Cool. Major supply from 75K to 78K, and major supply from 85,000 to 92,000, which means the supply zone is where a lot of buy orders are set. A lot of whales, a lot of big money bags, they've set their buy orders in those zones. We have major demand zone at 60,000 to 62,000. Then the next major demand zone is 52,000 to 55,000. If we do go down to 52K, that's a beautiful buy area, because basically Bitcoin was at 125,000, way down to 52,000. That is a spectacular buy zone. You can't go wrong with that. As a matter of fact, that's the reason why I haven't bought too much of stuff. I've been stacked on USDC. I haven't done too much because of this reason. Because if we do see 52K, I'm gonna throw the house and everything. I'm gonna focus on the like the majors, right? Like the Solana, Ethereum, and Bitcoin. Those three. And maybe some other stuff too. But yeah. So let's take a look at this real quick. We have then we have basically the momentum according to ChatGPT. Market's bearish right now on the daily time frame, but short-term oversold reaction bounce possible. So basically, we are very oversold, guys. Extreme. As a matter of fact, let me see. Let me take a look at this. I love looking at this stuff. So we are oversold right now for sure. Absolutely. So let me see if I can take a look at some. RSI. RSI candles, no. RSI. Like a flux charts. Let's see. One second. RSI 46. A second. Yeah, so basically the RSI in a 4 hour, I mean, at 62,000, when we dipped that where it's bullish, right? So RSI is bullish right now. Let me check the 15-minute. RSI is bearish in 15 minutes. So on the daily, RSI is bullish. On the 4 hour, RSI is bullish. On the weekly, RSI is bullish. Like, guys, we're oversold, guys. We're so oversold, it's crazy. Like it's nuts. But I want to see if we get the traditional. I like this indicator. Let me save it, because this kind of tells you, it gives you your it's a good long-term buy signal. The RSI, I like it. Look at it. Small little dip. Okay, cool. Let me I want to add another one. Let me see. RSI. RSI multi-length. Okay, perfect. All right. Okay, 1 second, guys. Yeah, we're very sold, man. But I think it probably shows you a lot better on like in 15 minutes, whatever. But we're very oversold, and there we go. Yeah, we're very oversold, guys. Extremely oversold. That's the reason why I think people use the RSI with their trading, of course. I think it says the RSI here, but okay, let me go back real quick. All right, so on the daily, you know, momentum is bearish in the short term basically meaning from the 5 minutes maybe to the an hour time frame, we are oversold. So we expect a bounce. That doesn't necessarily mean we're going all the way up, right? I mean, so I'm using ChatGPT to analyze the chart for us. So let's take a look at the next information it's giving us here. So probability outlook next 2 to 6 weeks, bearish continuation 60%. So basically there's a 60% chance price keeps coming down, likely sweep into 60,000 to 62,000 first, and if we break 60,000 we go into 52,000 55,000. So that's basically what we're saying. There's a 60% chance this happens. Full downside from here, basically that's a extra 10 to 20% downtrend if we do see that. But there's a 30% chance we see a relief rally. I spoke about this last week. So I don't believe we're just going to go to 60K from here first. I don't think so. I think there's going to be a day high bounce, right? If possible, so there's a possible relief rally first, a 30% chance of force, right? It bounced towards 75,000 to 78,000, then rejection from there. Then we're gonna go back down to about 60K. That's what it's saying. But that's a 30% chance. We have a 10% chance, very low probability this happens. A full reversal above if we get a strong claim above 78,000, then we're probably gonna go above 85K. Then that's a 25% pump. But it's very interesting, right? Why using this trade plans, no emotion, basically saying entry option 1. If we get above, if we get to 66.5, you should it's saying, I mean short no longer. Oh, short setup. So if we get to 66.5, it's saying basically if we close below this, it's shorts. Short setup. That's the first option. Second one is if we do get to 75,000 to 77,000, also short that too. And our long entries, if we do get to 60,000 to 62,000, put a long entry there. But it's so cool because it breaks down everything for you. I do highly recommend you guys use ChatGPT or any AI agent to help you, to give you short and long trades. I'm gonna use this. So what I normally do is I will set my trade entries based on this, right? If we do get to 66K, short it. If we get to 75,000, if we get to short option 1, if we do get it to 66,005, short it on the daily. If we do get 75K, also short that. We get to 60K, 62,000, go long on that. That is kind of what I'm doing here. So yeah, so key invalidation levels, bullish shift only above 78,000, bearish acceleration below 60,000. If we get 60K, we're probably going to go down. Macro breakdown below 52,000, but like I said, I do recommend you guys using ChatGPT to get your entries and all that shit, right? And bottom expectation, most likely sweep, a sweep of as low as 58,000 to 62,000, and in full panic flush, we get to 52,000. That's an absolute panic in the markets. That's going to cause a lot of liquidations, and of course, a beautiful entry for your long. So you don't get to 52,000 and now start to short. You've already had the opportunity to short the market at 125,000, right? You don't start to short the market at 52,000. No. Yeah, man. So yeah. Yeah, man, I freaking love this stuff. I mean, you could do this for any time frame, and it's very accurate. Like I said, I've tested it 3 times, and every single time it says short the rally. Every single time we've had, I think, let me show you guys real quick. Every time we've had a push, let me go to the, I think I used the 4-hour. Every time we've got a push into 70K, the market has come back down every single time. So basically, sell the rally every single time. Let me see. This was the first one. First one, we broke 71, went back down to 67. Broke up again to 70 to 71, broke back down all the way back down to 65. Broke up again into 70 recently, broke back down again. So basically 1, 2, 3, 4. So 4 times since February 5th. So 4 times in the past 11 days. 4 times in the past 11 days, we've broken 70K and we've come back down again. I don't know if the 5th time I break above higher or we've ended it, right? Who knows? But it's been interesting to see how this stuff works. So he says sell the rally and sell the rally into supply. The supply has been, as long as we've broken above 71, we've come back down 4 separate times. So we'll kind of see what happens there, man. Very interesting though. But it does work. I want to ask the guys to the show if they use. Yeah, Elijah, I do have a question. So do you guys ever use chat or any AI tool to help you analyze the charts, stuff like that? I've been using ChatGPT, and it is pretty, it's pretty accurate though. Everything you say, it is almost identical to what I when I use ChatGPT to help me analyze charts and give me entries and exits. Do you guys ever use that, anyone, or just me? Yeah, I'm asking on the show, but these guys are traders, right? He said that they don't use AI. Interesting. Because I've read some people using AI and they have like a 60 to 70% win rate using this. It's very interesting. Because I just think because the reason I'm asking this question because I know the reason I'm asking the question on the show, I'm live on right now, is because I know that a lot of institutions use AI to help them find and choose exits, buy, sell automatically. They don't stay at charts all day long. No. This stuff works, guys. There's no doubt about it, man. Because I've looked at it like, holy moly. Because it's basically taking all the information from traders on the internet, bring that information together, and you use that information to analyze charts and gives you entries and exits. Of course, it's not 100% foolproof, but it's better than Yeah, it's very interesting though. But yeah, I'm a big fan of it. I mean, of course, it's not 100% foolproof, but I think, especially for newer traders, especially for newer traders, man, it might be a way to it might be a way to to help you get ahead of it. It's very interesting. You, my friend is talking, Landy's talking. He can't hear him. My headphones are connected, but I was listening to what he's saying about how he doesn't use AI. He doesn't think we're there yet. Yeah, I do see a future because the way things are moving so fast now, and I do see a future where we're probably going to have AI bots trading for us, and of course it'll probably be customized to your risk, how much risk you want to take, but it just feels like, I'm sure a lot of other companies use AI to trade, right? I'm sure. But I just feel there's gonna be a day when you're gonna have AI just buy sell for you, man. It's just that day's probably already here, right? I'm sure. Yeah, I'm looking forward to it though. Definitely looking forward to it. Um, yeah. So what I say? So yeah, man. So that's the analysis from ChatGPT, analyzing the charts, giving us entries and exits, where to buy, where to sell. I recommend you guys use this stuff. It does give you, this is very, very simple. Like I said, you scan any charts, ask it to analyze the chart for you based on your time frame, ask it to give you entry exits, ask it to tell you, give it a chance to where it believes it might go, right? And it gives it to you. It's very fascinating. Very fascinating. But basically, it's saying a 60% chance we're probably going to go to 60,000 to 62,000. The question is, do we get a dead cat bounce first before we go there? That's the question. And that's where I don't know. That's where I really don't know, right? Let me see. Let me see real quick. Yeah, man. So, guys, like I said, the question is, is is Bitcoin going down first? Are we getting the dead cat bounce first? That's the question. And I think we're interested to find out if that happens. I do think we break above first before we come back down. Because in the short term, man, we've been destroyed, man. Jesus, I mean, I'll show you. We've been absolutely, the market has gotten absolutely killed. Let me show you guys. I mean, look at this. It's been nasty. Look at this nastiness, man. This is the hour candle. Look at how we've been absolutely destroyed recently. Let me go to the 4 hour to get a bigger view. I mean, look at this. Massive dumps, accumulation, massive dumps. So I'm assuming we would replicate. We had an accumulation zone here for a while, guys. So we had there's accumulation zone from March, sorry, from November of last year all the way down to January. So November, December, January, February. Sorry, January. Yeah, so about 4 months of accumulation, and we got dumped back down again, right? But we've only had basically just 1 month. We've had 1 month of accumulation. 1 month, that's it. So the low of February was 60,000, and we are now at 68,000. So we've only had 1 month. We've had basically not even 1 month, 16 days of accumulation. 16 days. So we last time, this last massive accumulation zone here lasted 4 months. I'm not saying that we're probably gonna have the exact same thing again, but if we do replicate that, we have basically 3 to 4 months of accumulation again before the next move. The next move could be up or could be down. Who the hell knows? But what I'm saying is, according to ChatGPT on daily time frame, we have a 60% chance of getting a deck high bounce first before a downturn to 52K. So we could accumulate here for a while, 3 to 4 months again, maybe we go up and range above like 70, 80K and go all the way back down to 60 to 52K. Who the hell knows, right? But if you're buying for a long term, accumulation zone now is not bad, right? Because even if you extend it, buying Bitcoin at 68K is not that bad. Buying at 52K is not that bad either. So you have a range between 52,000 to 60,000 or 68,000. That's not that bad at all. So just say you're buying Solana, for example. Solana is just say Solana is $86 right now. Let's say Solana goes to $65, right? Okay, you buy Solana at $65. It's low. You buy it at 80. It's not that, the difference is not too much. The difference is not too huge, you know what I mean? So yeah. So that's basically what I'm saying there. That's what I'm like. I'm not too worried about buying right now versus buying when it go lower. Even though I haven't really done much, I'm trading, yes. I'm shrinking the portfolio, yes. I haven't committed a lot of money yet. Not yet. I'm still, if we get a full dump, to me will be Bitcoin at 48, 50K. That's very bad. Very good. Yes, good for me, bad for a lot of people. If you do see those numbers, that would be an ultimate buy price for a lot. That's when that's your generational bottom there. That is your generational bottom, right? Yeah, so it's very interesting. It's very, very interesting though. So guys, I've been on about 48 minutes. I'm freaking hungry. I don't know what you guys are doing. Let's go play tennis. I don't know if it's gonna happen. I don't know. But yeah, let me Ethereum just broke 2K. So the market is trying to go up, man, right? We have seen positive inflows, right? Feels like it. Let me check something real quick. Yeah, interesting. Let me see. Let me see. Let me see something real quick. I want to check. I want to check something. I can't remember what I was going to do. My brain just went off. But yeah, man. So that's the daily time frame, guys, and on the 4 hour. So Long term seemed like we should be going down. Maybe short term feels like we should be getting a bounce, right? So we have a 60% chance that the market keeps going down, a 30% chance we get to move up first before we go back down, and 10% chance. That's why I say we're not in the bull market. We have a 10% chance of getting above 85,000 and higher. A 10% chance. That's very, very low. Very low. Let me take a look at YouTube real quick. Let's see if we could find any videos. Talk about any indicators we could use, but yeah, we've had four breaks above 70,000 in the past 12 days, and we got rejected. So maybe that could be it. We got one more. Who the hell knows? But things are very interesting right now, guys. Very interesting. 1 minute scout trading 4 days ago. I want to look at. I'm looking at YouTube now. I want to see if we have anything interesting here as far as. Let's see. Let's see. I don't see. I'm looking for any interesting indicators for you. Indicator videos, man. Top actually indicate. Oh wow, nice. Yeah, this is where I get my information from, man. I like this. This is cool. This kind of video I like right here.
5 TradingView trending indicators put through our scoring system, ranked from lowest performing to highest. Clear explanations of what they offer and if they're worth adding to your charts. Mean Deviation Loop. Created by LyraORS, this indicator applies mean absolute deviation, or MAD, calculations through 2 distinct methodologies, a Bollinger Band-style channel and a directional scoring loop. MAD measures volatility by calculating the average distance between price and a moving average, giving equal weight to all deviations regardless of size. Users select which signal mode to follow, or combine both through a hybrid scoring system. The Bollinger Band mode calculates MAD by measuring average absolute distance between price and a selected moving average over the look-back period defaulting to 25. The system then creates asymmetric bands using separate multipliers for upper at 1.4 times and lower at 1.0 times zones, triggering signals when price crosses these boundaries. The for-loop mode operates through a different mechanism. It weights the source price by MAD values, calculates a moving average of this weighted price, then runs a directional scoring loop. The combined signal mode averages the binary states from both Bollinger Band and for-loop methods. This normalized score crosses user-defined thresholds to determine final trade signals. A statistics table displays real-time signal states for all 3 modes simultaneously, allowing comparison of their current readings. Customization spans moving average type selection with 16 options from SMA to T3, separate length and multiplier controls for both calculation modes, independent threshold settings. The for-loop scoring replicates trend strength measurement available through simpler oscillators. All those separate thresholds and parameters create optimization risk, where you'll find settings that fit history perfectly but fail in live trading. Neural Probability Channel. Created through a collaboration between Harmony Algo and AlgoPoint, this indicator applies kernel regression mathematics to price analysis. At its core sits a rational quadratic kernel function that assigns weights to historical price points based on their proximity to the current bar, creating what the authors call a neural baseline, essentially a mathematically smoothed fair value estimate. The kernel engine processes price data through 3 key parameters: look-back window with a default of 24 bars, bandwidth for smoothness control defaulting to 8.0, and regression alpha set at 2.0 that determines whether the model focuses locally or considers broader context. Volatility measurement combines mean absolute deviation with ATR, producing hybrid channel bands at inner 1.5 times multiplier and outer 2.5 times multiplier distances from the baseline. The mean reversion logic triggers long signals when price crosses above the lower outer band, and short signals when crossing below the upper outer band, essentially buying oversold conditions and selling overbought ones. Unlike traditional Bollinger Bands, which use standard deviation, this indicator's mathematical foundation lies in kernel density estimation, a machine learning technique for probability distribution modeling. Trading applications center on mean reversion strategies where extreme band touches signal potential reversals. The inner bands can serve as partial profit targets, while outer bands mark entry zones. Traders might combine this with trend confirmation, entering mean reversion trades only when the baseline slope aligns with higher time frame direction. The mathematical terminology sounds impressive, but the practical output is just another volatility channel with mean reversion signals. You're essentially getting Bollinger Bands with extra steps and fancier language. Real trading performance would likely mirror traditional methods without providing meaningful edge over simpler alternatives. Trend lines. Created by Ebesi Halil, this indicator automates trendline detection through systematic pivot analysis. The system scans historical price action for pivot highs and lows using adjustable strength parameters ranging from 5 to 15, then identifies support and resistance lines by connecting pivots that align within a fixed ATR-based tolerance zone. The core algorithm searches for trend lines where at least 3 pivots, adjustable from 2 to 8, fall within 0.5 times ATR of a projected line, creating what the author calls zones rather than single lines. The logic includes a proximity-based filtering system that displays only the single nearest support and resistance zone to current price, preventing chart clutter while maintaining focus on immediately relevant levels. Breakout detection triggers alerts when price closes beyond zone boundaries after previously trading within them, while touch alerts activate when price wicks into the zone without breaking through. Customization includes adjustable look-back periods with a default of 300 bars, pivot source selection between high or low or close prices, minimum pivot confirmation requirements, and separate color controls for resistance and support with transparency settings. This solves a real problem since manually drawing trend lines is both time-consuming and subjective. The zone-based approach makes sense because support and resistance actually function as areas rather than precise price levels. However, those fixed ATR parameters become a limitation when switching between different instruments or adapting to changing market conditions. Breakout targets. Created by Algo Alpha, this indicator identifies price consolidation ranges through volatility analysis, then projects risk-reward targets when breakouts occur. Upon detecting consolidation, the algorithm identifies the most recent pivot high or low using a swing length parameter defaulting to 99, divided by 2 for lookback. It then determines whether the high or low pivot is more recent, using that as the range starting point. This creates dynamic ranges that adapt to actual market structure rather than fixed periods. The overlap prevention system checks whether proposed ranges intersect with existing active ranges before creation. Ranges extend forward each bar until price closes beyond their boundaries. Breakouts trigger when close exceeds the top for bullish or falls below the bottom for bearish, immediately removing the range and initiating target calculations. Target placement uses ATR-based stop-loss positioning, defaulting to 5 times ATR from entry as the risk reference. Take profit levels, multiply this risk distance by user-defined ratios. Lines and labels display entry price, stop loss, and all 3 targets with extending tracking until TP3 is reached. The system maintains all graphics until TP3 hits or a new breakout occurs. Customization includes range detection period, overlap prevention toggle, ATR period for volatility measurement, stop loss multiplier, and 3 independent TP multipliers. Color controls adjust bullish and bearish scheme elements. The volatility-based detection gives objective consolidation identification, which beats manually drawing boxes around ranges. The pivot-anchored construction adapts smartly to actual market structure. However, those fixed target ratios assume every breakout has the same potential regardless of range size or market conditions, which limits real-world adaptability. Order blocks volume delta 3D. Created by FluxChart, this indicator combines order block detection with volume delta analysis and 3D visualization. The system identifies order blocks through a point of control methodology that scans for break of structure events, then anchors zones at candles where price touched the most frequently tested level during the preceding range. The break of structure logic triggers when price closes beyond recent swing highs or lows with adjustable strength of 5. Volume delta measurement operates on either chart timeframe or lower timeframe data through security calls. For each identified order block, the system aggregates total volume, bull volume from close greater than open candles, and bear volume from close less than open candles that occurred at the point of control level during the formation range. These values convert to percentages displaying the bull-bear split within each zone. The 3D visualization constructs polyline depth faces using ATR-scaled offset coordinates, creating a perspective effect where zones appear to have front faces and top surfaces. Users choose between horizontal display with bull-bear split, shown top and bottom, or vertical display, with split shown left and right across the zone. The depth parameter controls how pronounced the 3D effect appears. Order blocks remain active until invalidation occurs via wick penetration or close beyond the zone, which is user selectable. The retest detection requires a very specific condition. The candle must open and close outside the zone while wicking into it. This ensures the retest happened during a continuation move rather than consolidation within the zone. Customization includes swing length, invalidation method selection, number of nearest zones to display ranging from 1 to 20, zone extension in candles, and comprehensive volume delta controls, including time frame selection and display style preferences. The point of control-based methodology actually advances beyond basic order block indicators by identifying the specific price level where institutions likely place their orders. The volume delta integration adds real evidence of buying and selling pressure rather than just guessing at order flow. The 3D visualization looks impressive, but doesn't add much analytical value beyond aesthetics. For those interested in the Quantum Ribbon Pro, we've built a comprehensive backtesting framework. Check the tutorial in the description to see how our community is validating their strategies.
Discover your new Mazda right now at Jeff Haas Mazda. Come lease a 2025 Mazda CX-5 for $303 per month for 36 months. The search is over. Visit us today at Jeff Haas Mazda.
In this indicator, the signals are generated by the help of volume-weighted money flow calculation, nonlinear flow strength correction, and volatility adaptive band construction. This is a next-generation indicator that you should add to your trading system now. To have this indicator on TradingView platform, here you just need to click on Indicators and search Smart Money Flow Cloud, this one, which is written by BOS Waves. Alright, this is the indicator, and as you can see, it's overlaid on the price chart. Before I start explaining the indicator and how you can use it in trading, if you like my contents, please support the channel by liking the video and subscribing to my channel if you haven't subscribed yet. Alright, let's see what we have here. Unlike other indicators that mainly rely on simple crossovers of lines or moving averages or create channels based on fixed multipliers for the bands, this indicator is built based on a volume flow detection system that, besides using price action for identifying direction and generating signals, it also uses money flow analysis, and it makes an adaptive volatility bands based on institutional levels of pressure and activity. So this indicator, instead of relying only on the price, it also uses a volume weighted money flow system to confirm the direction of the price based on the actual buying and selling volume in the market. Alright, let's see how we interpret this indicator. But before that, I'm proud to announce that recently I published a book, The Art of Price Action Trading, which is a complete guide to price action analysis. The link is in the description and you can get it later if you want to master price action trading. Alright, as you can see, we have a bands above and below this middle line, which is called baseline. Actually, we have two lines here. One is smoothed based on open and the other is smoothed based on closing price. When it is blue, the price is advancing in an uptrend, and when it is red, the price is declining declining in a downtrend. I will explain when and how this color changing is happening, and I will teach you a trading strategy based on this. So make sure you watch this video until the end. All right, as I said, we have two lines, which one of them is based on open and the other is based on closing price. The gap between the two lines shows intra-bar directional bias. So when there is a gap, the momentum is strong, and when there is no gap and the lines are close to each other, that shows that the momentum of that direction is weak, which can be just because of a pullback, like here in this example, or in a more serious situation, there can be a reversal and changing of the color. And then we have two bands above and below the baseline, which are not fixed and they are dynamic, and they have the ability to adapt to the current volatility of the market. In times that we have higher levels of activity, the bands are expanded, and in times that we have lower levels of activity, the bands are contracted. As I explained earlier, in this indicator, we have a volume-weighted money flow detection system. So this baseline is not calculated only based on the price, or these bands above and below the baseline are also not only calculated based on volatility, and volume flow strength or weakness are also considered in the calculation, so providing more accurate information. Basically, when the indicator is red, the price is declining in a downtrend, and when the indicator is blue, the price is advancing in an uptrend. And when the color changing happens, the indicator shows buy-sell signals. The color changing happens when the price closes above the upper band or close below the lower band. For example, here you can see that the indicator was red, and then the price closed above the upper band and the indicator turned to blue and showing buy signal. Or following this uptrend, here at this point, you can see that the price closed below the lower band, so the indicator turned to red and a sell signal is shown here. Now you may ask if you can trade only based on these buy-sell signals. No, because you can also have false signals like this buy signal here. So you need more confirmation before entering a trade based on these buy-sell signals, which I will explain later and teach you a trading strategy based on these signals. So make sure you watch this video until the end. This indicator also shows retest signal. Whenever the price reaches the baseline, a signal is shown by the indicator, and they can provide an opportunity to enter a trade in the pullbacks inside a trend. This indicator can be effectively used in two types of trading strategies: trend following strategy and reversal trading strategy. I will explain both of them and teach you how you can use these signals for entering a trade. In a trend following strategy, we use this indicator for trend identification, which means that we identify the current trend, and then by the help of another indicator or price action concepts, we try to find trading opportunities in the pullbacks inside the trend. As I said, the indicator itself also shows retest signals, and you can use these signals for entering a trade. For example, from here, you can see that the indicator is red, so we are in a downtrend and we should look for short position opportunities. A good opportunity is when we have a pullback, and the indicator shows these types of signals when the price reaches the baseline. So this was a potential trade entry, and this one, and also this one. And here in this part of the chart, you can see that from here, the indicator became blue. So we can say that the market is in an uptrend and we should look for long position opportunities. And as I said, the best opportunities are when there is a pullback in the market. So these retest signals could help us to enter a trade. But we don't trade only based on these retest signals, because we can encounter many false signals when a reversal is happening. What's up everybody, welcome to the channel. Soil here, and today I want to teach you a 1-minute scalping trading strategy which has a very high degree of accuracy. It's a very simple trading strategy, but for running it successfully and make profit with this scalping strategy, you need to consider some important points which I'll explain all of them throughout this video. Make sure you watch this video until the end so you don't miss any point. Without wasting any more time, let's get started. Alright, as I said, this is a 1-minute scalping trading strategy. So here the time frame of the chart should be on 1 minute. This is the price chart of Bitcoin, but you can also run this strategy on any other asset, whether it's crypto, forex, or stocks. The only requirement is that the asset must have high level of trading volume and liquidity on your exchange or broker, because we are working on a very low time frame and we don't want to see any slippage or insufficient order book, which can cause unreal price gaps that can damage our trade entry, stop loss, or take profit orders. In this trading strategy, we have 3 indicators, 2 MACD and 1 stochastic oscillator. For adding indicators to our chart, here we click on indicators and we simply search the name. The first one is stochastic oscillator, this one, and we must change its settings. Here for its K% length we set 7, for K% smoothing we set it at 3, and for D% smoothing 3 is fine. The next indicator we want to add is MACD, this one. And for this MACD, we must also change the settings. For the fast length, we set it at 13. And for the slow length, we set it at 21. We don't change anything else here in this tab. And in the style tab, we unselect MACD line and signal line, because in this strategy, we only need the histogram. We must add another MACD to our chart. And in its settings, in this tab, for the fast length, we set it at 34, and for the slow length, we set it at 144. Everything else in this tab is fine, and we go to Style tab, and similarly, we unselect MACD and Signal. Because as I said, in this scalping strategy, we only need to work with the histograms. Everything is already set on the chart, and before we start the strategy, please give this video a like, and if you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. Alright, now let's see how we trade based on this scalping strategy. We use this MACD, the MACD with the length values of 34 and 144 for identifying the short-term direction of the market. When this MACD histogram is red, the trend direction is down, and when this MACD histogram is green, the trend direction is up. This is a trend following trading strategy, meaning that we enter in the direction of the trend. So we need to identify pullbacks so we can enter in the direction of the market. For identifying the pullbacks, we use this MACD, the MACD with the values of 13 and 21 for the length. When this MACD is red, which means we are in a downtrend, then on this MACD, we must look for these green waves. When these green waves happen while this MACD is red, this means a pullback is happening. And the result could be just a pullback and then the price continues the downtrend direction, or it can be the starting point of a new trend. As you can see, after this green wave, this MACD turned green, showing an uptrend in the market. Alright, now you may wonder how to know when we should enter on these green waves. For this purpose, we use the stochastic oscillator. If the K% line in the stochastic oscillator, the blue line, is above 80 and then crosses below the D% line, it gives us the signal to enter a short position. So this MACD is red. We got a green wave on this MACD while this MACD is red. The stochastic K% line is above 80 and then crosses below the D% line. This is a signal for opening a short position. So we enter a short position here at this point. The stop loss for this trade should be placed above the highest high here at this point, so we set our stop loss here. And for the profit target, we take our profit when on this MACD we get 2 consecutive bars with light red color. So we take our profit here at this point. We set our profit target at this point. Moving on the chart, this MACD is still red. Here we got another green wave. The stochastic K% line is above 80 and then crosses below the D% line here at this point, which gives us the signal to open a short position here at this point. So here again, we can open a short position with the stop loss placed above the highest high here at this point. And for the profit target, we take our profit when on this MACD, we get 2 consecutive bars with the color of light red here. So we take our profit here at this point. We set profit target here. Again, here another green wave while this MACD is still red. The stochastic K% line is above 80 and then crosses below the D% line, giving us a signal for opening a short position here. So we can enter another short position here at this point. Similarly, the stop loss is placed above the highest high here at this point. And for the profit target, similarly, when on this MACD, we get 2 consecutive bars with the color light red. Will be actually on this point here, which doesn't provide a very good risk to reward ratio. It's still acceptable 1.6. Again, another green wave while this MACD is red. Stochastic K% line went above 80 and then crosses below the D% line, giving us another signal for opening a short position. So here again, we can enter another short position with the stop loss placed above the highest high in this area. And the profit target when we get 2 consecutive bars on this MACD with the color light red, which is here at this point. So we take the profit of this trade at this point. And when this MACD is green, which shows we are in an uptrend, then on this MACD, we must look for these red waves. When these red waves happen while this MACD is green, it means a pullback is happening. And then we take a look at the stochastic oscillator for identifying trade entries. When the K% line of the stochastic oscillator is below 20 and then crosses above the D% line, it gives us the buy signal or opening a long position. So here, this MACD is green. On this MACD, we got a red wave indicating that a pullback is happening. Then the stochastic K% line went below 20 and then crossed above the D% line, which gives us the signal to open a long position here at this point, starting of this candle. So we can open a long position here with the stop loss placed below the lowest low in this area. And for the profit target, we take our profit when on this MACD, we get 2 consecutive bars with light green color, which happened here. So the profit target should be taken at the end of this candle. Not a good one, risk to reward ratio of less than 1, but still didn't make any loss. Moving on the chart, this MACD is still green, and this MACD started giving us the red wave, but not any signal from the stochastic oscillator. And here at this point, the stochastic K% line is below 20, and here crosses above the D% line, which gives us to open a long position here at this point. So we can open another long position here with the stop loss placed below the lowest low in this area, and profit target when we get 2 consecutive light green bars on this MACD histogram, which happened here. So for this trade, we should take our profit here at this point. Please pay attention that sometimes the pullback or correction is so deep that in the time that when the stochastic oscillator gives us the signal on this MACD, we may see a very slight shift in the color, like what happened here, which was actually after the signal, or another small single bar here, which we can ignore it and show flexibility on it. Another important point that you must pay attention to it is that this is a trend following trading strategy. So it works well when the market is trending, and it doesn't work well when the market is flat and actually not trending. And this is when this MACD constantly changes color. So it's a good idea after an established period of trend, when this MACD changes color, give it a little time and see if it develops well in that direction or not. Along with this, you must also keep watching the price action. When you see the market is clearly flat, so you must stop trading until a trend starts and develops. And the most important aspect of this strategy that you must do is risk management. I explained how you must set the stop loss and profit target, but you must also define the amount of loss on each trade. This is a scalping trading strategy on 1 minute time frame, and you're going to trade actively in a day. You may have 20 tradings in a single day, and if you don't control how much you're going to lose, you will blow up your trading account faster than what you think. Losing trades are part of the game, and winning every single trade is impossible in reality. So besides setting stop loss to prevent unexpected losses, we need also define how much we're going to exactly lose on each trade if the market goes against us. There is a risk management strategy for active trading which is called 1% rule, and by the help of this strategy you only lose 1% of your trading account on each trade if the market goes against you. I explain it very shortly here because I have a complete guide to this strategy. The link is also in the description of this video, and I highly recommend you to watch it later because it's really important to manage your risk properly. Getting back to our strategy, as I said, we're going to lose 1% of our trading account on each trade in case if the market goes against us. Consider we have a $10,000 trading account, and on each trade we want to lose 1% of this, so that would be $100. Consider we want to enter a long position on Bitcoin at $30,000 and we want to set up the stop loss on 29,000 for example. So here the maximum loss per coin is $1,000. Now we divide our defined maximum loss amount, which is $100, 1% of our trading account, to the maximum loss per coin, which for this trade is $1,000. The result is 0.1, which is the amount of Bitcoin that we must buy. So we buy Bitcoin worth of $3,000, nearly 1/3 of our trading account, but without any worry, because if the price goes against our position, we only lose $100, only 1% of our trading account. I recommend you to watch my video on this, which there I explain everything in more details and more examples, so you will better understand the whole concept of this risk management strategy. The link is in the description, and it's highly recommended to watch if you're not familiar with this, because without this 1% risk management strategy, you cannot achieve success and consistent profit with the scalping strategy I explained in this video. Not only for this strategy, but in any other trading strategy, you must have a proper risk management strategy, and that's the vital key to your success. Please pay attention. If you're a beginner or you don't have much trading experiences, you shouldn't try this scalping trading strategy with real money. Scalping is not recommended for beginners because of the higher degree of risk in compared to other types of trading. Successfully scalping demands a well-developed psychology of trading and controlling emotions because of the high number of trades per day and the ability to manage them effectively. So if you're not an experienced trader, I highly recommend you to practice as much as you can and start with real money only if you're consistently profitable in paper trading. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading. What's up everybody, welcome to another scalping lesson. In today's video, I want to teach you a 1-minute scalping strategy for tracking institutional and large traders to discover when the smart money is active and flowing in the market. Please watch this video until the end because I'll mention important points which without paying attention to them, you cannot execute this strategy successfully and profitably. Stay tuned and let's get started. Alright, this is a 1-minute scalping strategy. So first we must set the chart time frame. On TradingView platform, here we set the chart time frame on 1 minute. In this strategy, we use negative volume index for tracking smart money and when it's active and flowing in the market. Here we click on indicators and we search negative volume index. There is no built-in indicator yet, and we must use community script. We use this one, which is written by someone named H. Potter, and we use it with default settings. If you're not familiar with negative volume index, it's actually a cumulative indicator that uses change in volume to decide when the smart money is active. It decides under this assumption that the smart money is active in time periods when volume decreases, and not so smart money is active in time periods when volume increases. Here the red line is MVI line, negative volume index line, and the blue line is a 255 period exponential moving average. Based on the research of Norman Fosbach, who created this indicator, there is a 96% chance of a bull market when MBI is above 255 EMA, but on the other hand, there is only 53% chance of a bear market when MBI is below its 255 EMA. So in this strategy, we only focus on bullish crossovers. In other words, we only focus in the times that MBI crosses above its 255 EMA. But this signal alone is not enough for us to take a trading decision because these crossovers are prone to be false signals and we need to filter the false signals. For doing this, we add another indicator. We add RSI, Relative Strength Index, and we use it with default settings. Everything is already set on the chart, and let's see how we trade based on this 1-minute scalping strategy. As I explained earlier, in this strategy we only focus on bullish crossovers of negative volume index because it has higher accuracy, and we're going to use RSI for confirming our trading decisions. When MBI line crosses above its 255 EMA, we enter a long position only if RSI is above 50. If it's below 50, we don't enter the trade. By having this filter, we don't enter in the times of pullbacks in downtrends. For example, here you can see that the price is in a downtrend, and in this situation, RSI is usually below 50. Here you can see that MBI line crossed above its 255 EMA, but this crossing, as you can see, just ended up with a short pullback. Without RSI, you may enter a long position here, but by having RSI, because RSI is below 50 at the time that MBI crossed above its EMA, we don't enter a long position here. Moving on the chart, here you can see that MBI crossed above EMA line, showing possible flowing of smart money. At the time that it's already crossed, RSI is above 50, so we can enter a long position here at this point. The stop loss for this trade can be placed below this swing low, and for the profit target, you can set it in advance at a level that makes risk to reward ratio equals 1.5, or you can take your profit based on price action. For example, in this case, after this pullback and when the price broke this resistance level, we can move our stop loss here below this pullback and lock in some profits. And then here, when this support level is broken, we can close our position and take our profit. Please pay attention that sometimes we have a situation like this when the MBI line goes below EMA a little bit and then crosses above that. This usually happens during pullbacks following an advancing of the price. At this point, we can enter a long position because our strategy confirms that smart money entered in the market, and this is possibly a pullback and the price is gonna advance. To lower your risk, it's better to wait for price action confirmation. You can see that after the signal, the price declined a little bit more, maybe putting our position in danger. But by price action analysis and confirmation, we can lower our risk. We enter a long position when this resistance line is broken. So we enter a long position here at this point when this new candle is opened. We have a similar situation here, but RSI is below 50. So it doesn't confirm taking any long position here at this point. And you can see that the price has turned to a downtrend. Please pay attention that this strategy doesn't generate trading signals regularly because this strategy focuses on tracking smart money. It gives signal in times that cumulative volume is higher than the average, in times of low volume activity of the market, which could show that possibly institutional and large traders are entering in the market. Another important point that you must pay attention is that here we are dealing with large traders who enter and may exit shortly after that. So always watch the price action carefully, and when you see signs of turning in the price with heavy volume, it's better to close your position if it's already in profit. But be careful not closing your position because of fear. Do it logically based on the price action and volume. And the most important part, risk management. This scalping strategy doesn't generate 100% guaranteed signals, and losing trades are part of the game, and you must manage your risk properly, which means that you must set your stop loss in a way that is based on your risk management strategy. For active trading such as scalping strategies, there is a risk management strategy that is called 1% rule. I have a complete guide on this. The link is also placed in the description of this video, and I highly recommend you to watch it because without a proper risk management strategy, you cannot successfully run the strategy I explained in this video. Not only for this strategy, but for any other trading strategies that you want to use, it's really important to manage your risk properly. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading. Welcome back to another video. Sohail here, and today I want to teach you a 5-minute scalping strategy which has unbelievably high degree of accuracy. Please watch this video until the end because I'll mention many important points about this trading strategy which without paying attention to them you cannot run it successfully. Stay tuned and let's get started. Alright, this is a 5-minute scalping strategy. So here we set the chart time frame on 5 minutes. This is the price chart of Euro to USD, but you can use this scalping strategy on any other asset, whether it's forex, crypto, or stocks. The only requirement is the trading volume and liquidity of the asset on your exchange or broker, because we don't want to experience unreal price gaps or large spread between buying and selling prices, which is caused by insufficient order book, and this can damage your trade entry, stop loss, or take profit order. In this strategy we use Heikin-Ashi charts. So here we set the chart type on Heikin-Ashi. For this trading strategy we must add 2 indicators to our chart. For adding indicators, here we click on indicators and we simply search the name. The first one is T3MA ribbon, this one. And for this indicator we must adjust the settings. Here in the inputs tab, for the fast length we set it on 11, and for the slow length we set it on 34. And also make sure this is checked using Heikin-Ashi candles for calculations. The next indicator that we want to add is RSI, Relative Strength Index. And for this indicator also we must adjust its settings. For RSI length we set it on 2, and in the style tab here for RSI upper band we set it on 80, and for RSI lower band we set it on 20. We click on OK. Everything is already set on the chart, and before we start the strategy, please give this video a like, and if you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. Alright, now let's see how we trade based on this trading strategy. This is a trend following strategy, which means we identify short-term trends in the market and then we try to find a perfect trade entry. We use T3 ribbon for identifying the direction of the market. Actually, these red and green waves you see on the chart. Having a red wave shows downside movement of the market, and having a green wave shows upside movement of the market. So when we have a green wave, we must look for a perfect opportunity for entering a long position. This is Heikin-Ashi chart. So when the price is advancing, we have consecutive strings of green candles, and when we have strings of red candles while the wave is green, it tells us that possibly a correction or pullback is forming after this advancing of the price, which can bring us a great opportunity to enter a low risk trade in the direction of the prior advancing of the price. For discovering if this is really a pullback and when it ends and the price is getting ready to bounce, we use our RSI indicator. Based on this strategy, alongside with the pullback, the RSI should go below 20, which shows oversold condition of the market and possible advancing of the price. When the RSI crosses above 20 line, it gives us the signal for opening a long position. So we enter a long position here as the new candle opens. The stop loss for this trade is placed just below the wave, and for the profit target, we close our position when this happens. The upper and lower lines cross each other and the wave color changes. So we take our profit here at this point. This was a trading setup for entering a long position, and when the wave is red, we must look for opening a short position. In this situation, we have consecutive strings of red candles when the price is declining and strings of green candles when a pullback is possibly forming. When we have this strings of green candles, then we must look at our RSI indicator for spotting trade entries. In this situation, the RSI should be above 80, showing overbought condition, and then crossing below the 80 line gives us the signal for opening a short position. Here, after this small pullback, we got RSI crossing at this point, but it's recommended not to take any trade instantly after this color changing of the wave, because there is a probability for the price to go to a trading range and moving sideways. I'll explain more about this later in this video. As you can see, this was a premature signal and the pullback actually continued after that. Here again, the RSI went above 80 and crossed below the line at this point, which gives us the signal for opening a short position. So we can enter a short position here as the new candle opens. The stop loss for this trade is placed above the wave, and the profit target here when the wave changes color at this point. So we can take our profit here when the price reaches to this level. Even if we miss this trade, we have another signal here, so we could enter a short position here at this point, or another one could be here also. Another one here, here, also here. But in this strategy, our goal is to enter in the early stages of developing so we can catch larger movements of the trend. Also pay attention as the price is moving in your favor. After each pullback and another signal, it's a good idea to move your stop loss down and lock in your profit. You can also add to your position after each new signal, but this increases your risk, so not recommended for beginners and conservative traders, and it's better to minimize your risk as much as possible. Please pay attention that when the price goes to the other side of the wave, you shouldn't take any trade until the direction is clear. For example, following this declining of the price is supposed to move below the upper line of the wave, below the wave or somewhere inside the wave, but not above the wave. So in this situation, when the price is above the wave, we don't take this signal for opening a short position. I mentioned earlier that when the wave changes color, it's a good idea not to take any instant trade, because many of the times the price go to a trading range and constantly changing color in this indicator, as you can see in this part of the chart. And also in times when you see the price is trapped in a wave like this and rapidly hitting the upper and lower line of the wave, it shows a very tight consolidation period and possibility of an explosive breakout in either direction. So also recommended not taking any action in these kinds of situations. Always keep in your mind that besides these indicators on the chart, you must also watch the price action carefully. When you can clearly see that the market is in a trading range and moving flat, you must stop trading, because this strategy is a trend following strategy. It works well when the market is trending, and it doesn't work well when the market is not trending. And the most important aspect of this strategy for running it successfully and profitably is risk management. This is a scalping strategy and you're going to trade actively in a day. So if you don't manage your risk properly, you may blow up your trading account faster than what you think, because losing trades are part of the game and it's impossible to win every trade. So you must exactly determine how much you will lose if the market goes against your position. There is a risk management strategy for active trading which is called 1% rule. The link is also in the description of this video and I highly recommend you to watch it, because without this risk management strategy, you cannot successfully run the strategy I explained in this video. Not only for this strategy, but for any other trading strategies, it's really important to manage your risk properly. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading. In this video, I want to teach you a famous trading strategy that is called 930. Alright, this strategy is an intraday trading strategy, meaning it's suitable for scalping and day trading. Time frames like 5 minutes, 15 minutes, and 1 hour are perfect choices for this trading strategy. In this strategy, we need to add 2 exponential moving averages to our chart. So here we click on indicators and we search EMA. This one, moving average exponential, and we add 2 of this indicator. And then we need to change their settings. For one of the moving averages, we set the length at 9, and here in the style tab we change the color to red, And then for the other moving average, we set the length of the moving average at 30. Here in the inputs tab, we set the length at 30. And the color blue is okay for this moving average. Everything is already set on the chart, and let's see how we trade based on the setup. Just make sure you watch this video until the end so you won't miss any important point about this trading strategy. This is a very easy trading strategy, and you just need to pay attention to all the important points that I'm going to explain. Unlike other moving average trading strategies that are usually based on the crossover of the two moving averages, this strategy is for trading based on pullbacks and entering in the current trend of the market. So this is a trend following strategy, providing high probability trades with minimum amount of risk. As I mentioned earlier, in this strategy, we don't use the crossovers, but instead we are going to take advantage of the area between the two moving averages to identify the pullbacks. The first step is to find out if the market is trending up or trending down. You can use price action analysis for this purpose, or you can add another indicator like MACD to identify trends, but by the help of these two moving averages that we have on the chart, we can simply identify trends of the market. The red line is an exponential moving average with length of 9, and the blue line is an exponential moving average with length of 30. When the red line is above the blue line, the market is trending up, and we should look for buying opportunities. In other words, to find trading opportunities for opening a long position. Regarding the trend identification, it is also a good idea to analyze multiple time frames to find out what are the overall trend or major support and resistance levels in the market, so you will be sure that you are on the right side of the market. I have a complete guide on this subject. The link is also placed in the description, and I highly recommend you to watch it later so you can learn multiple time frame analysis. Alright, so here, since the shorter EMA is above the longer EMA, we can consider that we are in an uptrend. In this situation, we must wait for a candle that is closed below the 9-period EMA. This is a signal of pullback, and this candle is considered our trigger candle. Please pay attention that the trigger candle must remain above the blue line. If the trigger candle is closed below the 30-period EMA, the signal is not valid anymore. In the next step, we must mark the high of our trigger candle, and then we wait for the price to close above the high of our trigger candle, which happened here. Please pay attention that this closing candle must show buying pressure. In other words, the closing price of the candle should be near to high of the candle. So if the candle is a kind of like weak candle, a doji long upper shadow showing rejection of the higher prices, we don't enter a trade. The closing candle should not show indecision or bearish pressure. This is a long position setup, and we wanted to show buying pressure. So here the signal is confirmed, and we can enter a long position at this point when this new candle is opened. The stop loss should be placed below the low of the trigger candle unless the candles after that have lower low. So basically we set the stop loss below the previous swing low, and for the profit target, if you intend to take short-term profit, you can set it in advance at the level that makes risk to reward ratio equals 1.5, which is the safest option if you intend to quickly take your profit and get out of your position. But if you want to stay longer in your position, you can close your position based on the behavior of price action. One profit target would be when you get a candle closed below the 9-period EMA, and another one would be when you get a candle closed below the 30 EMA. This is if you want to take the risk and stay longer just in case if the trend is going to go higher and higher, and you want to get the most out of your position if that's going to happen. Alright, now let me explain the setup for opening a short position. When the 9-period EMA is below the 30-period EMA, this shows that we are in a downtrend, and in this situation we must wait for a candle that is closed above the 9-period EMA. This is our trigger candle. We mark the low of the trigger candle, and we wait for the price to be closed below this low, which happened here by the help of this candle. This closing candle must show selling pressure. In other words, it should not be a weak candle, and the closing price of the candle should be near to low. This is a short position setup, and we want this candle to show selling pressure. The signal here is confirmed, and we can enter a short position at this point when this new candle is opened. The stop loss above the previous swing high, and the profit target at 1.5 risk to reward ratio. One important point that I must mention here is that when you get a trigger candle and after that you get lots of candles above the red line and not crossing below the low of the trigger candle in this example, this is not a valid setup. If this is a pullback and the downtrend still in effect, the pullback should be ended quickly, not more than 4 or 5 candles after the trigger candle. When we have a situation like this shows weakness in the trend. In this case, weakness in this downtrend. This shows that the bears are weakening and the bulls are gaining trading strength, and buyers were able to hold the price above the 9-period EMA and challenging this downtrend. As you can see, this downtrend ended and the market went flat, and then the price turned to an uptrend. 930 is an easy strategy, but very effective and accurate, that is based on pullbacks in trends, so offering high probability trades. But please pay attention that this doesn't mean it can provide you 100% guaranteed signals. No, this is not possible in reality, and losing positions are always part of the game, and you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's a perfect choice for scalping and day trading. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it, because without a proper risk management strategy, you cannot become a successful trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading. What's up everybody, welcome to another scalping lesson. Sohail here, and today I want to teach you a very simple scalping strategy that is run on 1 minute time frame. It's very easy and it has only one indicator, but for executing this trading strategy successfully and profitably, you need to pay attention to all the points that I'm going to explain in this video. Just make sure you watch this video until the end so you won't miss any important points. Alright, as I said, this is a 1 minute scalping strategy. So here we set the chart time frame on 1 minute. In this strategy we use Heikin-Ashi chart. So here we set the chart type on Heikin-Ashi. This is the price chart of euro to US dollar, but there is no limitation on this, and you can use this trading strategy on any other asset or market, whether it's forex, crypto, or stocks. The only requirement in terms of the asset or market is trading volume and liquidity, because this is a scalping strategy and we don't want to experience any unreal price gaps or large spread between bid and ask prices that can damage our trade entry, stop loss, and profit. As I mentioned earlier, in this scalping strategy we only use one indicator, and for adding it, here we click on indicators and we search CCI, Commodity Channel Index, this one, and we must adjust its settings. Here for the length we set it at 100. Everything is already set on the chart, and let's see how we trade based on this 1 minute scalping strategy. This is a volatility based strategy, and we're going to take advantage of increased volatility in either direction. So in compared to a trend following strategy where we enter in the direction of trends in the pullbacks, this trading strategy has higher risk, and we need to manage the risk properly, which at the end of this video I'll talk more about this. Based on this strategy, whenever CCI goes above 100 level and at the same time a Heikin-Ashi candle is closed in green color and not a doji, it gives us the signal to open a long position. Please pay attention that you must wait until this candle is closed and the CCI remains above 100, so we can enter a long position here at this point when this candle is actually closed. The stop loss for this trade can be placed below the previous swing low. And for the profit target, you can do it in two ways. You can set it in advance at a level that makes risk to reward ratio equals 1.5, or if you're an experienced trader with price action, especially on candlestick chart, you can analyze the price action and close the position when there is more probability for reversal. By doing this, you can get the most out of your position. For example, for this trade, you can see that the price went all the way up here to this point, making it a very profitable trade. But this method needs experience, and the safest option would be to set it in advance at the risk to reward ratio of 1.5 or 2 if you intend to take a little bit more risk. Moving on the chart, one important point that I must explain here is that these kinds of crossings are not accepted, because the CCI line was above 100, it came down a little bit and again went above 100, and most of the time it's just an exhaustion move like what happened here. Sometimes it can provide a good trading opportunity and sometimes not, so it's better not to take these kinds of signals. Moving forward on the chart, here CCI went below -100 level, and at the same time the Heikin-Ashi candle is closed red and not a doji candle, so we can enter a short position here at this point. For setting stop loss, the previous swing high is very far from our trade entry. Even this small pause is still considered far from our trade entry, as you can see. It's true that after that the price declined and we would collect our profit here, but this is a scalping strategy, and in practice we need to set the stop loss a little bit tighter. Setting it above this high of this candle would be a good place for stop loss of this trade, and the profit could be taken here at this point by setting in advance or all the way down to here. As you can see, that would make this trade very profitable. Moving forward on the chart, here again another opportunity for short position, which we could enter another short position here at this point with declining of the price all the way down to here. Moving forward, another opportunity of short position here, suggesting us to open another short position here at this point, but it's not a good one, as you can see. After that, here again another short position opportunity, so we can enter another short position here. This is a good one with declining of the price all the way down to here. Another short position opportunity here, so we can open another short position also here at this point when the candle is closed. And for this trade also the price declined all the way down to this point. Moving on the chart here, we got a long position opportunity, so we can enter a long position here at this point where this candle is closed, with setting a stop loss here below the swing low, and the profit of this trade could be collected here at this point, offering a risk to reward ratio of 2 for this trade, as you can see. This trading strategy is very simple and it offers good profit, but like any other trading strategy, it doesn't generate 100% guaranteed signals, and you need to manage your risk properly by using stop loss based on a proper risk management strategy. There is a risk management strategy that is called 1% rule, and it's a perfect strategy for scalping. I have a complete guide on this. The link is also placed in the description of this video, and I highly recommend you to watch it so you will learn how you can manage your risk properly. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in the next video, and good luck with your trading. In today's video, I want to teach you a very easy scalping strategy that makes consistent profit. As I said, this is a scalping strategy and it's suitable for 1 minute and 5 minutes time frame. Right now, we are on 5 minutes time frame. This is the price chart of euro to US dollar, but no limitation on this, and you can use this trading strategy on any other asset or market. The only requirement is high trading volume and liquidity, both in terms of the asset and the broker or exchange that you're trading, because this is a scalping strategy and we don't want to experience any unreal price gap or large spread between bid and ask prices that can damage our trade entry, stop loss, and profit. In this trading strategy, we have two indicators. The first indicator that we want to add is Turtle Trade Channels indicator. This one, which is written by Kivonk Ozbilgik. This indicator is based on a famous trading system that has proved to be profitable and consistent over the years. It's built based on Donchian channels and it was mainly used on higher time frames, but in this strategy, we're going to use the generated buy-sell signals on lower time frames in conjunction with another indicator. We just need to go to the settings of the indicator, and here in the style tab, we just remove the exit signals here because we don't need them in our strategy, and we're going to use only these long and short position signals. We need to filter the signals that happen during pullbacks or especially in flat market, so we must add another indicator for this purpose. Here we click on indicators and we search Andean oscillator, this one, which is an editor specs indicator and written by Alex Grover. This indicator will help us to know when the market is flat and in what times we have enough upside or downside momentum for entering a trade. Everything is already set on the chart, and before we start the strategy, please give this video a like, and if you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. Alright, trading based on this scalping strategy is very easy, and you just need to be focused on the signals and your entry, stop loss, and profit. When we have a short position signal here, we check Andean oscillator. If red line is already above the orange line, we enter a trade. If not, like this case, we wait to see if it crosses above the orange line or not. You can see that it happened here. So the short position signal is confirmed and we can enter a short position here as the new candle is opened. The stop loss for this trade is placed above the previous swing high and the profit at 1.5 risk to reward ratio. And when we have a long position signal, we wait to see if the green line crosses above the orange line or not. In this case, you can see that it didn't happen. So this long position signal here is rejected. And for this short position signal here in Andean oscillator, the red line crossed above the orange line here at this point. So the signal is confirmed and we can enter a short position here at this point where this new candle is opened. The stop loss above the previous swing high and the profit at 1.5 risk to reward ratio. Moving on the chart, here we have a buy signal, and in Andean oscillator, the green line crossed above the orange line here at this point. So the signal is confirmed and we can enter a long position at this point where this new candle is opened. The stop loss below the previous swing low here at this point, and the profit at 1.5 risk to reward ratio. All right, moving on the chart, here we have a short position signal, but it's rejected because we didn't have red line crossed above the orange line. And for this long position signal here, this is also a rejected signal because the green line didn't cross above the orange line. And here for this short position signal, the crossing of red line above the orange line happened here, which is very late, and especially in times like this case where the red line is moving on the orange line for a while, it's better to reject the signal. Here for this short position signal, the red line is above the orange line, so the signal is confirmed and we can enter a short position at this point where this new candle is opened. The stop loss above the previous swing high, and this trade is also a profitable trade as you can see. Moving on the chart, here we have another short position signal. The red line is already above the orange line, but this is a losing trade because the price advanced after that, and this is actually the reversal point of the market. This buy signal here not confirmed because we didn't have green line crossing above the orange line. Here we have a short position signal. This is also rejected because we didn't have crossing of red line above the orange line. And for this long position signal here, the green line crossed above the orange line at this point. So the signal is confirmed and we can enter a long position at this point where this new candle is opened. The stop loss below the previous swing low, and this trade is also a profitable trade as you can see. For this long position signal here, the signal is confirmed because green line is above the orange line. So another long position could be opened here at this point where the new candle is opened. The stop loss below the previous swing low, and this trade is also a profitable trade as you can see. And we continue like this. Please pay attention that no trading strategy gives you 100% guaranteed signals, and losing trades are always part of the game, just like the one that we had earlier. So you need to manage your risk properly. There is a risk management strategy that is called 1% roll, and it's a perfect choice for scalping strategies. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it because without a proper risk management strategy, you cannot become a successful trader. All right, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading. In today's video, I want to show you an extremely powerful indicator that is one of the best and most profitable indicator that you can find on TradingView. If you have ever heard of Market Cipher, so you know that they offer a package including 4 different indicators, and you have probably seen some traders that are using them, especially this one, Market Cipher B, which is actually the main indicator among these 4, and it generates buy-sell trading signals. But as you probably know, this comes with very expensive price, and not anyone can afford to subscribe to these plans. The good news is that we can have the Market Cipher be on TradingView for free, which is the exact copy of this indicator, just very slightly differences, which in practice doesn't matter. Here we click on indicators and we search Wu Manchu. This is the one, Wu Manchu Cipher B plus divergences, which is written by someone named Wu Manchu. As you can see, there is also Wu Manchu Cipher A, but in this video we focus on Cipher B, which is the main one and very popular and commonly used among traders. Alright, this is the indicator, and as you can see, it's added here below the chart. It's actually an oscillator, and you can see that we have many stuff here that are moving above and below the center line, which is 0. We don't need all of them, so better to remove them here in the settings so that we will have less confusing view of this indicator. This blue line is stochastic RSI, which we remove it since we don't need it in our strategy here in this video. In case if we need stochastic RSI, we can add it from here. And here in the style tab, we also uncheck VWAP. This yellow histogram is VWAP. We remove it because we don't need it and it hides some information that we need to see. Alright, now it's better. These blue waves that are oscillating above and below the center line are actually built based on wave trend indicator. We have two wave trends with different settings. One is in light blue color and the other is in dark blue color, and their crossings give us trading signals. When the light crosses above the dark, it's a buy signal, which are shown by these small green dots, and when the light crosses below the dark, it's a sell signal, and they are shown by these small red dots. Please pay attention that not all of these signals are suitable for trading, and we need to filter the false signals. I'm going to teach you a trading strategy based on these signals, so make sure you watch this video until the end. Alright, this indicator also shows divergences, divergence between wave trend and price, which in case that you need to use wave trend divergences in your trading strategy, you can simply use these divergences that are shown here by default. Since we don't need these divergences in this video, we go to settings, and here in the inputs tab, we uncheck divergences so we can better focus on the things that we need. There is also an option for hidden divergences, and in case if you need both of regular and hidden divergences, you can simply have them from here. Alright, another important component that we have here, and we're going to use it in our trading strategy, is this area here in the middle, which changes color between red and green. It's money flow index. When it's below 0, it's red and shown like this, and when it's above 0, it's green and shown like this. This will help us to know which way the money is flowing so we can be aware of the bullish or bearish sentiment of the market. This money flow index is also shown here below the charts for easier and faster identifying the MFI color, so we can take our trading decisions quickly in times that we just need to know if MFI is green or red. As I said earlier, not all of these signals are suitable for trading, and we need to filter the false signals. For this purpose, we add another two indicators to our chart. The first one is RSI, this one, Relative Strength Index, and we must change its settings. Here for the time frame, since we are on 5 minutes time frame, we set it at 15 minutes, so it will help us with the overall direction of the market on higher time frame. The next indicator that we want to add is Super Trend, this one, and it will help us with the current direction of the market. Alright, everything is already set on the chart, and let's see how we trade based on this strategy. For opening long position, we start from here. First of all, the money flow index should be green, which actually shows us bullish money flow in the market. As I said, you can easily identify the current color of MFI here. So when this is green, which usually coincides with wave trend above 0, then we focus on long position signals. The long position signal is confirmed only if super trend is green and RSI is above 50. So this signal is confirmed and taken. This signal is also taken. All these long position signals are taken up to here, where the money flow index becomes red and also wave trend goes below 0. From here, we focus on short position signals. For short position signals, super trend should be red and RSI should be below 50, which is not the case for this signal. Also, this one not confirmed, not confirmed, not confirmed. You can see that all of these short position signals are not confirmed up to here, which shows us that our strategy is correctly not confirming any trading signals where we are in a flat market. You can see that the market here is completely flat. Starting from here, super trend became red and RSI also went below 50, and since MFI line is still red, we can take these short position signals. This was just an example to show you how you can use these signals in practice so that you can only take the ones that have higher probability of getting the expected result. trading in the direction of the trend is the safest trading strategy, and this is a perfect indicator that can be used in trend following strategies. Although it's very powerful and it offers a range of indicators all in one, but we must use it in conjunction with other tools and aspects of technical analysis to reduce the number of false signals as much as possible. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.
Hey everybody, welcome to the channel. Soil here, and today I want to teach you a trading strategy which is called 930. It's a day trading setup based on exponential moving averages for trading pullbacks and riding the trends. If you are interested to learn this awesome day trading strategy, stay tuned and let's get started. Unlike other moving average strategies that are usually based on crossovers to generate reversal trading signals, 930 is a trading strategy for trading pullbacks and entering in the current direction of the market. As you all know the saying, trend is your friend. So by generating trading signals for riding on the trends, this trading strategy provides you high probability trades with minimum amount of risk. In this trading strategy, we use two exponential moving averages with length of 9 and 30. Here, the 9 EMA is our short-term moving average and the 30 EMA is actually our long-term moving average. And in this strategy, we're going to take advantage of the area between the two moving averages. This is a day trading strategy and time frames like 5 minutes, 15 minutes, and 1 hour are suitable for this trading strategy. As I just explained, this is a kind of trend following strategy and we want to enter in the pullbacks. So please pay attention that we don't use this strategy in flat markets, and we use this strategy only when the market is trending. So the first step is to find out if the market is trending or not. You can identify trends by the help of price action analysis. For example, if the market is making higher highs and higher lows, we can say the market is in an uptrend, or if it's making lower lows and lower highs, we can say the market is in a downtrend. I have a complete guide on this. I also put the link in the description of this video, and I recommend you to watch it later if you don't know how to correctly identify trends and draw trend lines. We can also discover the direction of the market by the help of these two moving averages. When the 9 EMA is above 30 EMA, the price is advancing and it's in a bullish trend. And when the 9 EMA is below the 30 EMA, the price is declining and it's in a bearish trend. You can also evaluate the strength of the trend by the help of the area between the two moving averages and the angle of the moving averages. The bigger the area between the moving averages and the steeper the angle of them, the stronger is the trend. And on the other hand, the smaller the area and the flatter the moving averages, the weaker the trend. Also, it's a good idea to analyze multiple time frames and have a look at the longer time frames to find out what are the overall trend and major support and resistance levels, so you can be sure that the trade entry you're taking on the shorter time frame is in the direction of the major trend on the longer time frame. If you're not familiar with multiple time frame analysis, I have a video on this, the link also in the description of this video, and I recommend you to watch it later to learn this valuable technique. Alright, now let's see how we get the trading signals in this strategy. For buy signal, or the signal for opening a long position, first the 9 period EMA must be above the 30 period EMA and the two moving averages must be apart from each other. In other words, you must see a space between them, and then we must wait for a candle that closes below the 9 period EMA, and this is considered our trigger candle. Please pay attention that the trigger candle must remain above the 30 period EMA to make this trading setup valid. When the price closes above the high of our trigger candle, it's a buy signal, or it's a signal for opening a long position. Aggressive traders may choose to enter a trade when the price passes the high of the trigger candle, but a safer entry is here when the price closes above the trigger candle high. Please pay attention that the closing candle must show buying pressure. In other words, the closing price of the candle must be close to the high of the candle. For example, at this point here, the price closed below the EMA 9 and we didn't have any close above its high until here, which is not a significant close above our trigger candle high, and they are actually dojis and show indecision. And you can see that here again the price went down below the EMA 9, and here we got a significant close above our trigger candle high. And for placing stop loss, we can use the trigger candle. For this trade, we can set the stop loss below the low of the trigger candle or the low of the breaking candle or any candle in between if it's lower than the trigger candle low, like here in this case that the between candles have lower low than the trigger candle. So we can set the stop loss here below this low. If you think it's very close to your trade entry and you don't want it to be so tight, or you're trading in a high volatility market like crypto, or you're trading in very short time frame which is very noisy, you can give it more room and place it below the 30 period EMA. For the profit target, if you intend to take short-term profit, if the price is moving in a channel, you can take your profit when the price reaches to the upper channel. And if it's not moving in a channel, you can approximately calculate the average of previous swing highs. If it's not applicable in your case, you can analyze the price action and exit your position when you see signs of increased selling pressure. And if you intend to stay longer in your position, in other words, you want to ride on the trend and get the most out of it, you can exit your position when the price closes below the 30 period moving average. One good strategy here is after every pullback, move your stop loss higher below the EMA 30. So by doing this, you lock in your profit. And for sell signal, or the signal for opening a short position, the 9 EMA must be below the 30 EMA, and the two moving averages must be apart from each other. In other words, we must see a space between them, and then we must wait for a candle that is closed above the 9 period EMA and is considered our trigger candle for the sell setup. When the price closes below the low of the trigger candle, it's a sell signal, or it's a signal for opening a short position. Aggressive traders may decide to enter a trade when the price passes the low of the trigger candle, but this has higher risk, and a less risky entry is here when the price closes below the low of the trigger candle. Please pay attention that the trigger candle, this candle that closed above 9 period EMA, must remain below the 30 period EMA to make this trading setup valid. The stop loss for this trade can be placed above the trigger candle high, or the high of the breaking candle, or any candle in between if it's higher than the trigger candle high, or you can set it above the 30 period EMA if you want to give it more room. And for profit target, similar to long position in our previous example, if you intend to take short-term profit, you can exit when the price reaches to lower channel, and if the price is not moving in a channel, you can calculate the average of previous swing lows and apply it for your profit target. Or you can just analyze the price action and exit when you see signs of increased buying pressure. And if you intend to ride on the trend and get the most out of it, you can exit your position when the price closes above the 30 period EMA. Moving your stop loss and setting it above 30 EMA after each pullback is a good strategy here to lock in your profit. 930 is an effective and powerful trading strategy that can be used in all financial markets. This is a pullback trading strategy in a trend, so the power and effectiveness of this trading strategy comes from the fact that entering in the direction of the trend provides you a high probability trade with minimum amount of risk. Please pay attention that this trading strategy doesn't provide 100% guaranteed signals for making profit, and is prone to false signals like any other strategy, especially when the market is highly volatile. So you must always prepare yourself when the price goes against you and have the required measures for your risk management strategy to limit your losses for that case. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you found any value in this video, please like it. Please subscribe to my channel if you haven't already, and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.
Welcome back to another video. Sohail here, and today I want to teach you a very profitable trading strategy which is called Magic Breakout. This trading strategy has extremely high degree of accuracy if you run it correctly, so make sure you watch this video until the end because I'll mention important points about this strategy which you must pay attention to them when using this awesome trading strategy. Without wasting any more time, let's get started. Alright, this trading strategy is based on intraday timeframes from 15 minutes to 4 hours, suitable for day trading to possibly swing trading. Based on my personal experiences, 1 hour time frame is the best among them, so I continue this video on 1 hour time frame. In this trading strategy, we have 4 indicators: CCI, commodity channel index, and 3 EMAs, exponential moving averages. For adding indicators, here we click on indicators and we simply search the name CCI, this one. We use this indicator with its default settings. Just make sure the length is 20 and the source HLC3, and here SMA for method with length of 5. And in the style tab, make sure that the upper band is 100 and the lower band -100. Now we must add 3 exponential moving averages to our chart. We can add them separately, or an easier way is to add moving average ribbon, this one, which gives us 4 moving averages. Here in the settings, we unselect one of them because we need 3 moving averages in this trading strategy. Here in this field, we set EMA because we need exponential moving averages in this trading strategy. Then we must set 34 for the length of the 3 exponential moving averages. And finally, we must change the source of calculation for our EMAs. For the first one on high, for the second one on close, and for the third one on low. We click on OK. Everything is already set on the chart. And before we start the strategy, please give this video a like. And if you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. All right, now let's see how we trade based on this trading strategy. This is a trend following strategy. So the first thing that must be identified is existence of a trend. How we do it? By the help of these 3 EMAs we already added to our chart. In this strategy, we consider that these 3 EMAs are one indicator and we call it wave. So this is wave top, wave middle, and wave bottom. When the price crosses the wave in an upside move and the price is above the wave bottom, we can consider that advancing of the price just started. Then based on this strategy, the price should go above the wave top, and stay there for some times, and after that it must decline and enter the wave. In other words, at this moment the price was above the wave and then ideally crossed the wave top in a downside move, or at least it must be in the touching point of the wave top. Pay attention that the price shouldn't go below the wave bottom considerably. Then we take a look at the CCI, which is actually going to give us the trading signal. When the CCI crosses above the +100 line, this is a signal for opening a long position, but there is a condition that must be met. We must check and see if CCI was below +100 line for at least 5 candles before the cross. Again, we check if the price is still above the wave bottom, and if this is also met, we buy or enter a long position here as the new candle opens. So at this point would be our trade entry for long position, and the stop loss for this trade is placed just below the wave bottom. And the profit target for this trade can be placed at 2 levels. One could be here when the price goes below the wave. Actually, you see a candle closed below the wave bottom, which this profit target is more suitable for traders who intend to give more room to the price action and catch larger movements of the trend. And another profit target could be here when we see a candle closed below the wave top, which this profit target is more suitable for traders who are more conservative and intend to take their profits earlier. One important point that you must pay attention is that the pullback to the wave shouldn't go below the wave in this case of bullish market. For example, at this part of the chart, you can clearly see that here the price crossed above the wave, stayed there for some times, but then the correction was so deep that it went below the wave. In the return, here CCI gave the signal and other conditions are also met, and the price truly advanced after that, as you can see. But we don't take this trade because here the price went below the wave bottom and it could be the starting point of a downtrend. We want to lower our risk as much as possible, so we only focus on when the price is in the touching point of the wave or penetrate the wave like this, but not going below the wave. Based on our strategy, when we have this condition, the market is considered bearish. Let me show you a bearish signal based on this trading strategy, so it will be clear for you. When the price crosses the wave in a downside move and it's below the wave top, the market is considered to be a downtrend or possibly flat before starting of the downtrend. Then the price should go below the wave bottom, staying there for some times, and after that it must advance and touch or enter the wave, which provides the base for CCI. And in this situation, when CCI crosses below -100, it's a sell signal. But similarly here, there is a condition that must be met. The CCI must be above the -100 line for at least 5 candles before the cross. Then again, we check the price to see if the price is still below the wave top. If this is also met, then we enter a short position. In this case, you can see that the swing of the price is very small and the touching or penetration is also not satisfying. Even if we consider these conditions good, the CCI crossed below -100 at this point, but for the 5 candles before the crossing, the CCI was not above -100, so the signal is rejected here. By practicing more with this trading strategy, you will better understand from the first look of the swing and the pullback if it's a good one or not. So here we give another chance to the price for a better swing and pullback. Here the price touches the wave, and after that CCI crosses below -100 line here at this point. For the previous 5 candles, the CCI was above -100, actually very close or running on the line, which is a little risky, but as long as the condition is met, we continue. At the time of crossing, the price is still below the wave top, so we enter a short position here as the new candle opens. This can be our trade entry for opening a short position. The stop loss is similarly placed above the wave top. And for the profit target, we can set it somewhere around here when the candle closes above the wave bottom or above the wave top. So we can take our profit for this trade, possibly here. Please pay attention that this is a trend following trading strategy, which means it works well when the market is trending, but it doesn't work well when the market is in a trading range, moving sideways. This trading strategy is strong enough not to frequently provide signals when the market is flat. For example, here after this downtrend stopped and the market went to a trading range, this trading strategy didn't give false signals most of the time, because in this situation of flat market, the price usually moves very closely to the wave, as you can see, which doesn't create that kinds of swings and pullbacks we need in this strategy. And in cases that it moves further away from the wave, in the pullback, the price goes to the other side of the wave because the market is in a trading range. So you must pay attention to this important point and stop trading when you can clearly see that the market is moving sideways. This usually happens when an existing trend weakens and stops continuing in that direction. So it's a good idea not to take any trade in times when a trend is stopped and the price is in the process of changing to a new trend or possibly continuing its prior direction. All right, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading. Welcome back to another video. Soil here, and today I want to teach you how you can trade price channels. In this video, you will learn some effective price channel trading strategies and some important tips to consider when trading based on price channels. Before we get started, please give this video a like, and if you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. Alright, first let's see what a price channel is. A price channel forms on a chart when the price moves between two parallel lines. Depending on the direction of the market, we have three types of channels: horizontal channel, ascending channel, and descending channel. When a price channel appears on a chart, there are some strategies that help us to take advantage of the price channels and trade based on them. The first one is trend channel trading strategy, which is the most simple and popular one. Here we take advantage of a trending market. So by identifying ascending or descending price channels, we take advantage of the movement inside the channel to spot the best positions to enter in the trend. When the channel slopes upward, in other words, we have ascending price channel, this shows that the market is in an uptrend. So when the price reaches to the channel's support line, we buy or we enter in a long position, and then we sell and take our profit when the price reaches to channel's resistance line and we have signs of pausing and turning of the price. Please pay attention that because we never know if the price is going to break the support level and a reversal is going to happen, so we must also use other tools and concepts of technical analysis for confirming our trade. For example, we can use volume to measure buying or selling pressure in the market, or we can analyze candlestick patterns to verify the direction of the price, and many other tools or concepts that we can use for this purpose. And on the other hand, when the channel slopes downward, or in other words, it's a descending price channel, it indicates that the market is in a downtrend. So when the price reaches to the channel's resistance line, we sell or we enter in a short position, and then we close our position and take our profit when the price reaches to channel's support line and we have signs of reversal and changing in the direction. The next one is price channel breakout trading strategy. Here we take advantage of a breakout. When a reversal happens and the price breaks out of the channel, it must be confirmed that it's a breakout, not a false breakout. The first thing that we must analyze is the breaking candle that must show strength and considerable move in the breaking of the channel, and this must coincide with considerable increase in volume, which shows increased pressure and interest in the direction of the market. Aggressive traders who take more risk enter the market when these conditions are met, but please pay attention that many of the times the breakout turns out to be a false breakout. So conservative traders wait for the retest of the broken level, because sometimes after the breakout we have a pullback and the price retests the broken level and then turns back in the direction of the breakout. By waiting for the retest and then entering in a trade when the market turns back in the direction of the breakout, conservative traders make sure that they don't get caught in false breakouts. I have a complete guide on how to confirm breakouts. The link also in the description of this video, and I recommend you to watch it later because there I explain in details how you can correctly confirm breakouts. And the third strategy is price channel consolidation trading strategy. Here we take advantage of horizontal price channel, which is also known as trading range. The good point with this situation is that you can buy or sell without the fear of going against the current trend, because there is no trend. The market is in a trading range. But this good point doesn't necessarily mean more profit, because trading in ranges is more risky and you can rarely catch any big movements in consolidation periods in compared to trends. When the price reaches to the channel's support level, we can buy or enter a long position, and then when the price reaches to resistance level of the channel, we can sell or close our position and take our profit. And then when the price again is falling from the resistance level, we can enter a short position and then close our position and take our profit when the price reaches to the support level of the channel. And please pay attention that here also we must use this strategy in conjunction with other tools and concepts of technical analysis, because these levels can be broken anytime and we must confirm that the price is going to bounce or fall from these lines. Similar to the strategy number 2, here also a breakout can happen and the price can break out of the channel in either direction, and we must confirm the breakout as I've already discussed. Please pay attention that you shouldn't wait for a perfect setup and you must show flexibility. A perfect channel where on every swing candlesticks exactly touch the tip of the line rarely happens, and in practice we may see candles getting very closely to the line but not touching them, or you may see a few candles slightly shooting out of the channel. So you must show flexibility on these situations. Always remember that support and resistance levels are not necessarily a line, and sometimes a zone better describes the price action. And the most important point when you're trading price channels is risk management and having stop loss for your trades. markets. In financial markets, every trading decision is based on possibilities. Some trading setups may have higher probability of success and some lower, but there is always probability of failure, and the market can suddenly turn against you. So you must always prepare yourself and have the required measures in your risk management strategy for that case. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading. In today's video, I want to introduce a free indicator on TradingView that can make you consistent profit. Just make sure you watch this video until the end because I'm going to teach you a trading strategy based on this indicator that gives the most accurate buy-sell signals ever. Alright, to add this amazing indicator to our chart, here we click on indicators and we search Rainbow RSI. This one, Rainbow Adaptive RSI, which is a free indicator from Lux Algo. Alright, this is the indicator and it's an improved version of RSI where it uses an adaptive moving average as an input for RSI, and by doing so it minimizes the impact of retracements. Let me add the original RSI to our chart, this one, Relative Strength Index, to illustrate how they differ from each other. With the original RSI, you know that it's very sensitive to retracements or pullbacks in the market, and unfortunately it generates many false signals, whether it's crossing below 80 or crossing below its moving average line or even crossing below 50. But as you can see, these are all false signals and the trend is continuing its upside direction. But with this new and improved version of RSI, as long as it's green, whether it's above 80 or goes below 80, we conclude that the market is in an uptrend and the price is moving higher and higher. When it turns to orange color, it tells us that the uptrend is weakening, and here we have three scenarios. It may be a deep pullback and after that the price continues advancing, or it may be the case that the uptrend is really weakening and the price may go to a trading range before either continuation of the prior trend or reversal. And in the third situation, this can be a sign that a reversal is happening now, which is the case here. And when our indicator turns to red color, it shows that the market is in a downtrend and the price is declining. But in the same period, you can see how RSI is generating all these oversold readings, crossing above 20, crossing above its moving average line, and even crossing above 50, while the downtrend is continuing its downside movement. And similarly here, when it turns to orange color, it shows that the downtrend is weakening, and we have the three scenarios that I just explained, which in this case we got a deep pullback and after that the price made lower low. The indicator turned to red color here, but it couldn't stay in red color and it turned to orange, and it seems that the price is going to a trading range. This indicator also provides buy-sell signals by the help of these small dots when the two lines of the indicator cross each other, actually when the ribbon turns to green or red. But we shouldn't rely only on these signals, because in situations like this where we have a deep pullback, we can have a false signal like this, or in times that the market is in a trading range like here in this part, we can have many false signals. Alright, now that you learn how you can use this indicator for identifying trends and evaluating the strength or weakness of trends, let me teach you a trading strategy based on this indicator, which is highly profitable. For this strategy, we add another two indicators. Here we click on indicators and we search parabolic SAR. We add this one, which is a built-in indicator in TradingView platform, and we need to adjust its settings. Here in the inputs tab, for the start we set it at 0.01, and for the increment also we set it at 0.01, and for the max value we set it at 0.1. Alright, and the next indicator that we want to add is squeeze index, this one, which is a free indicator from Lux Algo, and we're going to use this indicator with its default settings. Alright, everything is already set on the chart, and let's see how we trade based on this trading strategy. We use this Rainbow RSI for trend identification, as I explained earlier, and we use squeeze index for identifying non-trending market. When it's above 80 and red, it shows that the market is not trending, which can be a trading range like here, or it can be during the pullbacks. And we use parabolic SAR for evaluating momentum changes in the market. If you're familiar with this indicator, when it's below zero, the price is advancing, and when it's above zero, the price is declining. All right, when rainbow RSI is green, we look for long position opportunities. In this situation, we wait for the squeeze index to go above 80 and becoming red, which can possibly show a pullback in the market. And then when it crosses back below 80, it's a buy signal. It's a buy signal because rainbow RSI is green and the trend is up. The signal is confirmed if parabolic SAR is below the price. So we can enter a long position here as this new candle is opened. The stop loss for this trade is placed below the previous swing low, and the profit order for this trade is placed at the level that makes risk to reward ratio equals 1.5. And as you can see, it's a profitable trade. After this trade, we got another signal here, which is a confirmed signal, so we can enter another long position here at this point. And this trade is also a profitable trade, as you can see. From here, the squeeze became red, but it didn't go back below 80, and it shows that the market is not trending here in this part. And we wait until a new trend is established, which from here, the rainbow RSI became red and telling us that the market is in a downtrend. Similarly, we wait for the squeeze index to go above 80 and crosses back below 80, and the signal is confirmed only if the parabolic SAR is above the price. So we can enter a short position here as this new candle is opened. And after this trade, which is a profitable trade, another short position could be entered here at this point after this signal. But for this trade, which we would place our stop loss here above the previous swing high, you can see that our stop loss would probably hit here, unless if, for example, we would place it a little bit higher. And this trade would probably end up in loss because here our stop loss would hit. Although after that, the price declined and could potentially reach to our target. But because of this deep pullback that formed here, and I explained this about earlier, this position would end up in loss. Actually, we could avoid this loss, for example, here when there is a sign that the downtrend is weakening here when it's turned to orange color. So by the help of this sign, we could also close our position around here with no loss. But please pay attention that this is an important point that you must pay attention. Although this strategy is very accurate, but it doesn't mean it generates 100% guaranteed signals, and you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's a perfect choice for active trading. I have a complete guide on this. The link is also placed in the description of this video, and I highly recommend you to watch it because risk management is the most important factor in your trading success. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in the next video, and good luck with your trading.
Hey everybody, welcome to the channel. Soil here, and today I want to teach you how you can make a simple calculator that automatically calculates the position size based on 1% role risk management strategy. In this video, I'm using Google Sheets, but you can also make it on Microsoft Excel or numbers in Mac OS, or you can even create a small application if you know how to code. It's a very handy tool for trading, and as an active trader, you need a calculator like this so you can effectively evaluate your trading decisions as fast as possible. All right, let's see how we can create a calculator like this. As I already mentioned, this calculator is based on 1% role risk management strategy, which means that after spotting a trading opportunity and finding the appropriate entry level, stop loss level, and take profit level, then we calculate the position size in a way that if the price hits the stop loss order, we only lose 1% of our trading account. I don't want to get into more details regarding this strategy because I have a complete guide on this. The link is also in the description of this video, and I recommend you to watch it first if you're not familiar with this risk management strategy. All right, let's begin making the calculator. Here we select two cells, and by the help of this tool, we merge the cells. While the merged cells are selected, here we make the background color to, let's make it green. Then we double click on the merge cell and we type long. Here, by the help of this tool, we place it at center. Here we bold it. And here we make the text color to white. We repeat this one more time for short position. Here we select two cells and we merge them. we make the background color to red. In the merge cells, we type shorts. We place it at the center. We bold it and we make the text color white. All right, here in the left column, in this row, we type balance. Next row, entry. Here, SL. And here, TP. We don't type anything here in this row. And here we type max loss. Here, amount to buy. And here, risk to reward. Then we select all of them. And here we align them to the right. While all of them are selected, we right click and select copy and we paste it here. These two columns must also be aligned to right. All right, let's begin with long position. Consider we have $10,000 in our trading account. So here for the balance, we enter 10,000. And also consider, for example, we are trading Bitcoin, and after analyzing the market, we found out that 20,000 is a good price to buy. So here for the entry, we enter 20,000. Consider we want to set our stop loss at 19,000 and we want to take our profit at 22,000, for example. Please pay attention that in long positions, your SL is always lower than your entry price and your TP is always higher than your entry price. You can make some conditions for these cells to only accept the correct values, or you can make some formats for these cells, but I don't want to explain them because this is not a tutorial for Google Sheets or Microsoft Excel, and I want to make this calculator as simple as possible. So when you're trading, you must be focused on what you're doing, and here for SL, you enter a price which is lower than your entry price, and here for TP, you enter a price that is higher than your entry price. Otherwise, the calculations will be wrong. All right, these are the cells that we fill every time that we are entering a trade, and these cells will be calculated automatically, and now we want to give them some formulas. Here, we define the maximum loss that we intend to take based on our balance, and we want it to be only 1% of this. You can also set it to 2% and take more risk, but it's better to stick with 1% rule. All right, in this cell, first we type the equal sign, which is actually the starting point for giving a formula to the sheet. Then we click on the cell that contains the amount of the balance, which is E6. And if you pay attention, you can see that it's written here automatically, and it's also shown here. Then we enter star sign, which acts as multiply function, and then we enter 0.01 and we press the enter. Here it's suggested autofill, which we reject the suggestion. You can see that it turned 100, which is actually 1% of our balance. Then for the amount to buy, again we type equal sign, then we click on the cell that contains the maximum loss, and this is divided by parenthesis, and now we must enter loss per coin. If we buy one Bitcoin at $20,000 and then sold at SL level, which is $19,000, we lose $1,000, and this is loss per coin, which is actually entry price minus SL. So we click on the cell that contains entry price minus, and then we click on the cell that contains SL. We close it with parenthesis and we press the enter, and you can see that it turned 0.1, and this is actually the amount of Bitcoin that we must buy. So if we buy 0.1 Bitcoin at $20,000 and we set the SL at 19,000 and TP at 22,000, and if the market goes against our position and hit our SL, we only lose $100, which is actually 1% of our balance. And here we give this cell a formula to calculate the risk to reward ratio for us so we can easily evaluate our trading decisions. We enter equal sign, then parenthesis, we click on the amount of TP minus entry price, and we close the parenthesis, and this is divided by, we open a parenthesis, entry price minus SL. We close the parenthesis and we press the enter. And as you can see, it turned the risk to reward ratio of this position, which is 2. And this means we are risking $100 to gain $200 reward. This part is done, and you can simply use this for long positions in your futures trading. You don't do anything with this part because here in this part, the output is shown based on the data you enter here. So this is the part you work with. For example, you have $30,000 in your trading account and you want to buy Bitcoin at 18,000. You want to set your stop loss at 16,000 and your take profit order at 21,000. And by pressing enter when the last data is entered, you can see that these are automatically calculated based on the data you entered. And these are very helpful when you want to enter a trade instantly and you need to take your decisions quickly. All right, now let's make this part of the calculator, which is for short position. Consider we have $10,000 trading account and we want to enter a short position for Bitcoin at $20,000. Please pay attention that in short positions, SL is placed above the entry price and the profit target below the entry price, because here we make profit by declining of the price. Consider we set the stop loss at 21,000 and take profit order at 18,000. Here for the max loss, similarly we enter equal sign, then we click on the amount of balance multiplied by 0.01. Here again is suggested autofill, which we reject suggestion, and you can see that it turned $100, which is 1% of our balance. Here for the amount to buy, the formula is a little different because here the maximum loss per coin is SL minus entry. So we enter equal sign, then maximum loss divided by parenthesis SL price minus entry price. We close the parenthesis and we press the enter. And here for risk to reward ratio, similarly we start with equal sign, we open a parenthesis, entry price minus TP, we close the parenthesis, and this is divided by, we open a parenthesis, SL minus entry. We close the parenthesis and we press the enter. This part is already completed and it's used for opening short positions. Please pay attention, as I mentioned earlier, we don't do anything with these parts. These cells contains formulas and they only show the output, and the output shown here is based on the inputs that we enter in these cells. So these are the required data that we must enter, and then these informations will be automatically calculated. You can set some conditions on these cells for entering only the correct values, or you can format these cells or lock these cells so you won't accidentally change the formulas. In this video, the focus was not teaching spreadsheet software, so I didn't get into more details, and I just wanted to show you how you can simply make a calculator for your risk management strategy so you can use it in practice for evaluating your trading decisions. All right, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.
You're gonna see the best settings of EMA and you're gonna learn the most accurate trading strategy, but only if you exactly follow the instructions that I'm gonna explain. So make sure you watch this video until the end and let's get started. But before we start, if you like my contents, please support the channel by liking the video and subscribing to my channel if you haven't subscribed yet. Alright, we need to add 7 exponential moving averages to our chart, but don't worry if you are on the free version of TradingView, because I will teach you how you can have 7 moving averages on your chart. Here we click on indicators and we search ribbon. This one, moving average ribbon. And by the help of this indicator, we can have 4 moving averages on our chart, but we need to change the settings. So here we go to the settings of the indicator, and here we give the special settings that we need in our trading strategy. But you may ask, what is the special settings and what makes it so special? For the settings, we're going to use Fibonacci numbers. As you know, Fibonacci numbers and ratios are like magic, and they are found everywhere from nature and biology to formation of Rocks and Galaxy, and they have also application in financial markets for unknown reasons. We're going to use Fibonacci numbers for the length of our moving averages. But before that, we need to change the type of our moving averages. As I said, we need exponential moving averages. So here we set EMA for them. Then here for the first EMA, we set the length at 5. For the second EMA, we set the length at 8. For the third EMA, we set the length at 13. And for the last EMA, we set the length at 21. The colors are okay, and we just go to the Style tab and we increase the thickness of the lines so they will be better visible on our price charts. All right, we're done with the settings of these 4 exponential moving averages. And now we need to add another 3 exponential moving averages. So here we click on indicators, and again, we search ribbon, this one, moving average ribbon. And for these moving averages, also we need to give them special settings. So here we go to the settings of the ribbon, and here in the inputs tab, first we remove one of them because here we need 3 exponential moving averages, and here we set the type of moving average EMA for them. And then for the length, again, we use a Fibonacci number, but this time 3 of the moving averages will have the same length. So here for the first EMA, we set the length at 144. For the second one, also 144. And for the third EMA, also 144. For the first EMA, the source of calculation should be set at high. For the second EMA, it should be close. And for the third EMA, the source of calculation should be set at low. Then we need to change their colors, and we set the color to green for them. And finally, we go to the Style tab and we increase the thickness of the lines so they will be better visible on our price chart. All right, we're done with the settings of our moving averages. And now let me teach you how you can find accurate buy-sell signals based on this. But before that, I'm proud to announce that recently I published a book, The Art of Price Action Trading, which is a complete guide to price action analysis. The link is in the description and you can get it later if you want to master price action trading. All right, getting back to our trading strategy. As you can see, we have 2 collections of moving averages that are separate from each other, but we're going to use them together to find trading opportunities. From now, we call this collection of moving averages as green ribbon, and we call this collection of moving averages orange ribbon. This green ribbon is used for trend identification. When the price is above the green ribbon, the market is in an uptrend, and when the price is below the green ribbon, the market is in a downtrend. So in times that the price crosses above or below the green ribbon, it can be a reversal point of the market. But we don't trade just based on crossover signals because it is risky and we can encounter many false signals if we only rely on price crossovers as buy-sell signals. So we're going to use a set of conditions and then mixed with a price action concept to find low-risk trading opportunities in the market. Let me show how you can do it. First, I explain long position setup, and then I will explain a short position setup. For a long position setup, we want a situation like this where the price crosses above the green ribbon and we get a candle closed above the green ribbon. So the price should be below the green ribbon, and then the price go inside the ribbon and keep advancing, and we get a candle that is closed above the green ribbon. Here you can see that this candle is closed above the green ribbon. This is an initial signal that probably the price is turning to an uptrend, but we need more confirmation before entering any trade. In the next step, from here, when we got a candle closed above the green ribbon, we wait for the orange ribbon to completely go inside the green ribbon or above that. At this point, when this candle is closed, you can see that the orange ribbon is completely inside the green ribbon. You can see that this red line, which is the longest EMA, it went inside the green ribbon. So here at this point, when this candle is closed, we have the orange ribbon completely inside the green ribbon or above that. In the next step, we focus on the price and we want a pullback of the price to the green ribbon. It can be just touching of the green ribbon, or it can go inside the ribbon, which is our case here, and it is the ideal situation. If the price goes below the green ribbon but still very close or in touch with the green ribbon, it is accepted and we can wait for our final confirmation. But if it just goes down and the distance becomes bigger, it can be a signal that the upside momentum is not strong enough to turn the price to an uptrend. All right, here you can see that we got a pullback to the green ribbon. When the price goes for a pullback, this swing high that is created here, it can play as a potential resistance level for the price when the price is turning up. So we mark this level and we wait to see if the price can close above this level or not. At this point, this candle, you can see that it is closed above this resistance level. Since the candle is weak, we evaluate the moving averages to see how the momentum is. You can see that when this candle is closed, the orange ribbon is completely closed above the green ribbon. There is no overlap between them, and this is a signal that we have a strong upside momentum. And also you can see that all moving averages are in order from short to long, and this further confirms that we have a strong upside momentum. So although the breaking candle is weak, but the moving averages are suggesting that the situation is okay. So the buy signal here is confirmed, and in practice we could enter a long position at this point when the new candle was opened. The stop loss for this trade is placed below the orange ribbon or even below the green ribbon, which is a safer place in case if it is not very far from your trade entry. In our case here, if we set below the green ribbon, it is far from our trade entry, so we set it here below the orange ribbon. And for the profit target, we set it at risk to reward ratio of 2. This was a long position setup, and now let me teach you a short position setup. For a short position setup, we want crossing of the price below the ribbon, the green ribbon, and having a candle closed below the green ribbon. So for this setup, the price should be above the green ribbon, and then we have the price going down inside the ribbon, the green ribbon, and then we get a candle that is closed below the green ribbon. You can see that it happened here. We got a red candle that is closed below the green ribbon. In the next step, we want the orange ribbon to completely go inside the green ribbon or below that. At this point, when this candle is closed, you can see that the orange ribbon is completely inside the green ribbon. The red line here, which is the longest EMA, you can see that it is inside the green ribbon. From now, we wait for a pullback of the price to the green ribbon. As I said, it can be just touching of the green ribbon or ideally going inside the ribbon, which is the case here. If the price goes above the green ribbon, we want it to be very close or in touch with the green ribbon. If it goes far, it can be a signal that the downside momentum is not strong enough to turn the price to a downtrend. In the next step, we use price action confirmation. When the price goes for a pullback, here a swing low is created, which can act as a potential support level. We mark this low and we wait for the price to close below this level. Here you can see that we got a red candle that is closed below this potential support level. The breaking candle is strong and showing downside pressure. In case if the breaking candle is not strong, we can evaluate the moving averages like our previous example. In this case, you can see that we have a long red candle and the lower shadow is also very small, and this shows a strong downside momentum. So the sell signal here is confirmed, and in practice we could enter a short position here at this point when the new candle was opened. The stop loss above the orange ribbon or above the green ribbon if it is not far from our trade entry, and profit target at risk to reward ratio of 2. Please pay attention that we can have a situation like this where the market goes to a trading range. For example, here the price was below the green ribbon and then the price crossed above the green ribbon and we got a candle closed above the green ribbon, as you can see. But after that, the price went to a trading range. The rules of our trading strategy will help us a lot to not enter a trade in this situation. For example, in this case, after the price closed above the green ribbon, you can see that we didn't get the orange ribbon completely inside the green ribbon up to this point where the orange ribbon is completely inside the green ribbon. Then we got a pullback to the green ribbon, but in the advancing of the price after the pullback, the price couldn't close above this swing high and again went down. Here now it's clear that the market is in a trading range, but in other cases, we may get a false signal, for example here. As I said, the conditions that we have in this trading strategy and with different layers of confirmation that we should follow in this trading strategy, it helps us to avoid majority of the false signals in situation like this where the market goes to a trading range. But still, you can have false signals. There is no trading strategy or method that can give you guaranteed signals. No, this is not possible, and losing positions are always part of the game, and you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's one of the best risk management strategies that you can use. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it, because without a proper risk management strategy, you cannot become a consistently profitable trader. All right, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.
In today's video, I want to teach you a very easy trading strategy that can make you money consistently. At the moment, we are on 1-day time frame, but this trading strategy can also be used on lower time frames. This is the price chart of euro to US dollar, but no limitation on this, and you can use this trading strategy on any other asset or market, whether it's forex, crypto, or stocks. In this trading strategy, we have two indicators. The first one that we want to add is MA band distance monitor, this one, which is written by someone named Hassan Rifat. Alright, this is the indicator, and basically nothing new or complicated. It's just a combination of two moving averages with some information about the distance between them. Here in its settings, you can see that by default, we have a slow moving average with length of 200 and fast moving average with length of 50, and both of them are simple moving averages that are calculated based on closing price. For our trading strategy, these default settings are perfect because we're going to use this indicator for trend identification. So we continue with the default settings. This is our fast moving average. I mean, the lower part of this band is fast moving average, which is set with length of 50. And this is our slow moving average with length of 200. And you can see that it's moving farther away from the price action. When the faster moving average crosses above the slow moving average and stays above that, the area in between becomes green, and it shows that we are in an uptrend. And in this situation, the price also moves above the band. And when the faster moving average crosses below this lower one and stays below that, the area in between becomes orange, and it shows that we are in a downtrend. And in this situation, the price moves below the band. These crossings can give us signals on the reversal point of the market. For example, here it could be a buy signal, here a sell signal, and here a buy signal. But it's not always like this, and especially when the market is in a trading range, like here in this part, we can have many false signals. So if you want to use these crossings for identifying reversal points of the market, make sure that you are also using other indicators for more confirmation. In our trading strategy, we use this indicator for trend identification, and we don't use these crossings for entering a trade. So when the band is green, we look for long position opportunities, and when the band is orange, we look for short position opportunities. Here we have also a table that shows the current price distance from both of fast and slow moving averages, and also the average of the two. Knowing about the distance of the price from moving averages helps you to evaluate the strength of trends, so you can avoid false signals. In times that the price is near to the slow moving average, like for example here, or for another example here, where the price is near the slow moving average line, this situation shows that the trend is weakening. And in this situation, the band also becomes tighter because the moving averages are crossing, like here as you can see, or for another example here. In this situation, we don't take any trades. I will show you examples later, don't worry about this. And the next indicator that we want to add is Andean oscillator, this one, which is an editor specs indicator and written by Alex Grover. All right, this is the Andean oscillator, and we're going to use it with its default settings, and it will help us to identify increased momentum during trends. Everything is already set on the chart, and before we start the strategy, please give this video a like, and if you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. All right, as I said, we use this moving average band
And for trend identification, when it's green, we look for long position opportunities. For example, from here, it became green. And if you look at the Andean oscillator, you can see that the green line is already above the red line and the orange line. We must wait for a pullback to enter a trade. When the price touches or goes inside the band, it shows that probably we are having a pullback. And by the help of the Andean oscillator, we can find out when the pullback is ended. When pullback happens in Andean oscillator, the green line goes below the red line. So we wait for the green line to go below the red line, which shows a possible pullback in the market. And then we wait for the green line to cross back above the red line and then crosses above the orange line. You can see that we have this condition here and also here. The trade is confirmed when the green line has already crossed above the orange line. So we can enter a long position here as this new candle is opened. The stop loss for this trade is placed below the previous swing low and the profit target at the level that makes risk to reward ratio equals 2. And you can see that this trade was a profitable trade. Moving on the chart here, you can see that the green line again went below the red line, showing a possible pullback. But you can see that the price continued going down and even crossed below the band, which means our uptrend is in danger. Here you can see that we have our green line crossed above the red line and then it crossed above the orange line here at this point. The band is still green, but you can see that the band is very narrow. The distance between them is very small. Just compare it, for example, with this part. This is telling us that we have a weakened upside momentum. So this signal is rejected and we don't enter any long position here. And you can see that after that, the price actually turned to a downtrend. And from here, the band became orange. When the band is orange, it shows that we are in a downtrend. So we must look for short position opportunities. In this situation, we wait for the red line to go below the green line, which shows a possible pullback. And then we wait for the red line to cross back above the green line and then the orange line. When the red line is already crossed above the orange line, the signal is confirmed and we can enter a short position here as this new candle is opened. The stop loss for this trade is placed above the previous swing high and the profit at the risk to reward ratio of 2. Alright, moving on the chart, you can see that here again the red line went below the green line, showing a possible pullback, and then it crossed back above the green line and then the orange line. So the short position signal is confirmed and we can enter a short position here, and you can see that this trade is also a profitable trade. Shortly after this trade, you can see that again the red line went below the green line, and after that it crossed above the green line and above the orange line here at this point, providing another short position opportunity here. So in case if we miss this one, we could enter a short position here at this point. Moving forward on the chart here, again the red line went below the green line, and after that it crossed back above the green line and then the orange line here at this point. So another short position signal is confirmed and we could enter a short position here, and this trade is also a successful trade as you can see. Moving forward on the chart here, you can see that the red line went below the green line, but before going above the orange line, you can see that the green line went above the orange line and we had actually a reversal here, and the band also turned to green here at this point as you can see, and we didn't have any false short position signals around here. Here the band is green, so we must look for long position opportunities. We wait for the green line to go below the red line, and then we wait for the green line to cross back above the red line and then the orange line. So here the signal is confirmed and we could enter a long position based on this signal on the opening price of this candle, and we continue like this. Please pay attention that although this trading strategy has very high degree of accuracy, but it doesn't mean it generates 100% guaranteed signals. Losing trades are always part of the game, no matter how accurate is the strategy or how much experience you have. You need to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's one of the best risk management strategies that you can use for trading. I have a complete guide on this. The link is also placed in the description of this video, and I highly recommend you to watch it because without a proper risk management strategy, you cannot become a successful trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.
Welcome back to another scalping lesson. Soil here, and today I want to teach you a 1-minute scalping strategy for catching trends in the early stages of developing. It's very easy and highly profitable only if you pay attention to all the points that I'm going to explain in this video. Just make sure you watch this video until the end so you won't miss any important point. Stay tuned and let's get started. Alright, as I said, this is a 1-minute scalping strategy. So first we must set the chart time frame. On TradingView platform, here we set the chart time frame on 1 minute. This is the price chart of Euro to US dollar of Forex market, but you can use this strategy on any other asset, whether it's Forex, crypto, or stocks. The only requirement in terms of the asset or market is liquidity and trading volume, because this is a scalping strategy and the profit and loss that we're going to take are small in terms of price movements, so we don't want to experience any unreal price gaps or large spread between bid and ask prices, because this can damage our trade entry, stop loss, and profit. In this scalping strategy, we must add 4 indicators. For adding indicators, here we click on indicators and we simply search the name. The first one that we should add is Sniper, and we're going to add this one, FX Sniper T3CCI, which is written by someone named H. Potter. After adding it to our chart, we must change its settings. Here for CCI period, we set it at 35. We click on OK. And now we must add 3 exponential moving averages to our chart. An easier way is to add a ribbon to our chart, this one, so we can manage all of them here in the settings in one place. We need 3 moving averages, so we uncheck one of them. 3 of them should be exponential moving averages, so we set EMA for them. 3 of them should have lengths of 96. And the calculation for the first one should be based on low, for the second one based on HLC3, and for the third one based on high. We click on OK and it's done. Everything is already set on the chart, and let's see how we trade based on this 1-minute scalping strategy. These 3 moving averages provide us a support and resistance zone. When the price is above the zone, the market is considered to be in an uptrend, so this zone acts as a support level. And when the price is below the zone, the market is considered to be in a downtrend, and this zone acts as a resistance level. By the help of this strategy, we want to catch the turning points of the market where a new trend forms. Let's begin with how we enter a long position. When the price closes above this zone and at the same time Sniper indicator closes above 0 and turns green, it gives us the signal that an uptrend is probably forming. But this is not enough, because by trading only based on this signal, we will encounter many false signals. So we need some filters and more confirmations for any trading decision. First, before this crossing happens, the price must be in a well-shaped wave or a complete swing below this zone. Actually, we must have considerable distance between price and the moving averages. For example, these ones that you see here are not accepted. When the price keeps crossing and moves closely to the zone, it shows the market is flat. And in this situation, the number of false signals are considerably high. So please pay attention that we need a well-shaped wave or a complete swing below the zone with some distances from the moving averages before breaking this zone, which is actually acting as a resistance level here. When the price successfully breaks the zone and closes above the zone, which is actually a resistance level here, and at the same time the Sniper indicator is also above 0 and green, we must wait for a pullback to this zone, and we enter a trade when this resistance line, which is actually a resistance level formed by this high, is broken. Why we do this? Because having all the requirements up to here doesn't necessarily mean that the price is going to advance with high probability. And you can see that the price declined after that, and it could continue to lower levels below the zone and hit our stop loss. And also sometimes here the price goes to a consolidation period, which I will show you later in another example. So we need to lower our risk, and we enter a trade only when we are sure that this is a pullback and the price is going to advance. So we enter only when this resistance level is broken, which happened here by the help of this candle. So we can enter a long position here at this
this point as the new candle is opened. The stop loss for this trade is placed below the pullback, actually below our moving average zone. And for the profit target, we can act in 3 different ways. One way is set it in advance at the level that makes the risk to reward ratio equals 2, or the other way is to moving our stop loss and lock in some profit. In this method, we move our stop loss below the pullbacks in a similar way that we set our initial stop loss. For example, we can move our initial stop loss to this level when this high is broken, which actually happened here. So when this happened, we move our stop loss here below this pullback. Then we can move it here below this pullback when this high is broken, after that here, and so on. This method will be very profitable when the trend keeps continuing higher and higher. And the third method of taking our profit is when we get the first candle closed below this zone, which at this situation the zone is acting as a support level, so we close our position when we get a candle closed below this support zone. Here the price went below the zone, but not a good shaped wave, very close to the zone, so we don't take any action here. Here we got a very sharp declining of the price, probably a news release or a fundamental effect. And here staying below the zone for a while with an accepted distance from the moving average zone. Here the price crossed above the zone with sniper indicator being green in this situation, and we should wait for a pullback, which happened very slowly here. Here the price couldn't break this resistance level and decline again and forming a consolidation period as I mentioned earlier. So now we should wait until this range is broken, which happened here. So we enter a long position here at this point as this new candle is opened. The stop loss for the trade is placed below the moving average zone, and for the profit target we can take it at the risk to reward ratio of 2, or we can probably take it when we get the first candle closed below the zone, which happened here. Moving on the charts, here after this wave the price crossed above the zone but couldn't stay there, and after that some short crossings very close to the zone, actually a flat market. Here after this wave the price crossed above the zone, we got a pullback, but again no success to stay above the zone and couldn't break this resistance level and declined, so not a proper signal based on our strategy. Here also a similar situation. We move on the chart, and here also we got some short crossings, not well-shaped waves, so we don't take any action. Also here we move on the chart, and here after this wave, which can be considered as a well-shaped wave, the price crossed below the zone with sniper indicator turning red and going below 0. As you can see, we must wait for a pullback, which happened here, and we must wait for breaking of this support level. It happened here at this point, so we can enter a short position here as this new candle is opened. The stop loss for this trade is placed above the moving average zone, and for the profit target, if we set it at the risk to reward ratio of 2, the profit is taken successfully. But if we wait for a candle closed above the zone, which happened here, we end up with a very small profit. Moving on the chart, here we have another opportunity for opening a short position. Here after this wave the price crossed below the zone, sniper indicator is also red at the time of crossing. Here we got a pullback to the zone, and here this support level is broken by the help of this candle, so we enter a short position here as this new candle is opened. The stop loss for this trade is similarly placed above the moving average zone, and the profit of this trade can be taken all the way down here when the price closed above the zone, or you can set it in advance at the level that makes the risk to reward ratio equals 2. In compared to trend following strategies, this strategy has a little higher risk because here we try to catch the turning points of the market where a reversal happens and a new trend forms. So it's really important to manage your risk properly. There is a risk management strategy that is called 1% rule, and it's a very good risk management strategy for scalping. I have a complete guide on this. The link is also placed in the description of this video, and I highly recommend you to watch it because without a proper
proper risk management strategy, you cannot successfully and profitably run the scalping strategy that I explained in this video. Not only for this strategy, but for any other trading strategies that you want to use, it's very important to manage your risk properly. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new video. See you guys in next video and good luck with your trading. In this video, I want to teach you a secret trading strategy that nobody knows. First, we set the time frame on 1 minute because this is a scalping strategy. You can also use it on 5 minutes time frame, but in this video, we use 1 minute time frame. This is the price chart of euro to US dollar, but no limitation on this, and you can use this trading strategy on any other asset or market, whether it's forex, crypto, or stock market. The only requirement is high trading volume and liquidity because this is a scalping strategy and the profit and loss that we're going to make are small, so we don't want to experience any unreal price gap or large spread between bid and ask prices that can damage our trade entry, stop loss, and profit. In this trading strategy, we have two indicators. The first one is Keltner channels, this one, and we're going to use it with its default settings. The next indicator that we should add is smoothed Heikin-Ashi candles, this one, smoothed Heikin-Ashi candles version 1, which is written by Jack VMK, and also with this indicator, the default settings are perfect for our trading strategy. Everything is already set on the chart, and let me teach you how you can trade based on this very accurate scalping strategy. As you can see, we have the smoothed Heikin-Ashi candles here in the middle of the Keltner channels. Whenever the Heikin-Ashi candles becomes red, it's a sell signal, and when they become green, it's a buy signal. But there are also other conditions that should be available before we enter a trade. When we have a sell signal, which is actually when the candle of the price chart is closed and the color of the Heikin-Ashi candle becomes red, the signal is confirmed only if the corresponding candle is closed below the middle line of the Keltner channels, but it should not be below the lower band of the Keltner channels. In other words, when we have a sell signal, which is when the Heikin-Ashi candle turns to red, the corresponding candle, I mean the price chart candlestick, should be closed in the lower half of the Keltner channel. So here the sell signal is confirmed and we can enter a short position at this point when this new candle is opened. The stop loss is placed above the previous swing high, which is at this level, but in cases like this that it is far from our trade entry, you can set it here above the upper band of the Keltner channels, and the profit target for this trade is set at 1.5 risk to reward ratio. This was a short position setup, and on the other hand, when Heikin-Ashi candles turn to green, it is a buy signal, and the signal is confirmed only if the corresponding candle is closed above the middle line of the Keltner channels but not above the upper band of the Keltner channels. In other words, the candle is closed in the upper half of the Keltner channels. So here the signal is confirmed and we can enter a long position at this point when this new candle is opened. The stop loss for this trade is placed below the previous swing low and the profit target at 1.5 risk to reward ratio, which happened here at this price level. This is a very accurate and profitable scalping strategy, but to become consistently profitable, you need to manage your risk properly because this strategy doesn't give you 100% guaranteed signals. No strategy is capable of this, and losing positions are always part of the game, and you need to manage your risk properly. Otherwise, you will lose your trading account sooner or later. There is a risk management strategy that is called 1% rule, and it's a perfect choice for scalping and day trading strategies. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it because without a proper risk management strategy, you cannot become a successful trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new video. See you guys in next video and good luck with your trading.
What time frame should I use? This is the most commonly asked question among traders. In this video, I'm going to explain every detail that you need to know about time frames. You will learn the differences between different time frames, how you can choose the best time frames based on your trading style, what is top-down analysis, how you can analyze multiple time frames simultaneously, and the importance of top-down analysis for finding the best trading opportunities in the market. Without wasting any more time, let's get started. All right, in trading, one of the basic things that you learn is price chart, a chart that shows the movement of the price. And the most common type of price chart is candlestick chart. This chart that you see here, there are different types of price charts, but candlestick chart is the most commonly used price chart among traders because it can give you more information about what happened during a time period. Then you need to choose a time frame for your chart, which can be from seconds, minutes, hours to day, week, and months. And this is the most challenging part for traders, especially beginners. To understand the differences between different time frames, you need to completely understand the basic element of this chart, which is a candlestick. Right now we are on 1 day time frame. So here the x-axis is divided based on every day: April 23, April 24, April 25, April 26. And for each day we have a candlestick which has 4 parts: opening price, closing price, highest price, and lowest price. If the closing price is above the opening price, the candle is green, and if the closing price is below the opening price, the candle is red. So for example, here in April 6, the market opened here at this price, and then the market closed at this price. This is the highest price during the day, and this is the lowest price. This is all we know about April 26. Different types of candles have different meaning and interpretation, but I don't want to talk about them in this video because here the focus is on time frame. In case if you're interested to know about different types of candles and candlestick patterns, I have a complete guide on this subject. The link is also placed in the description and you can check it later. All right, now let's switch to 4 hours time frame and see what happens on our chart. When you are on 4 hours time frame, the x-axis is divided based on every 4 hours. Let me mark the area for April 26 so you better understand what is going on here. April 26 started here, so I draw a rectangle from here down to here. All right, these are 4 hours candles for April 26. For the one candle of April 26 on daily time frame, we have 6 candles here. These are included in that one candle on daily time frame, but here we have formation of the candles every 4 hours, and this is giving us more information on how the price changed during April 26. All right, now let's go to lower time frames, for example 1 hour, and now you can see we have even more candles. This is the same period starting of April 26, which is actually from here, because here we are on 1 hour time frame. We can see more precisely when April 26 started. So let's put the rectangle starting from here. This is where April 26 started, and this is ending of the April 26. Market is closed now. Here on this time frame, the x-axis is divided based on every hour. So one candle on daily time frame is equivalent of 24 candles here on 1 hour time frame. At the moment, it is less than 24 because the market is closed now. But during the week, you will see 24 candles. Here, the market is closed at 20 p.m. UTC time zone. So as you can see, because we came to lower time frame, we can see more movements of the price during the day. And please pay attention that in compared to 4 hours time frame, for one candle on 4 hours, we have 4 candles here on 1 hour time frame. Now let's go to lower time frames, for example 15 minutes time frame, and here you can see that we have even more details about the price and how it moved during this period. This is the same April 26, but here we have much more candles and we see more details, we see more noises, because every 15 minutes a candle is formed on the chart. And when we switch to very low time frames, like for example 1 minute, you can see that we have lots of details, lots of noises. We can see exactly how the price moved during that period, the same period April 26, and how the price action performed during that day. You can see that here we have well-established uptrend, downtrend. You can draw trend lines, support and resistance levels, and these are all happening inside one candle. This candle, which formed here on April 26. Here on this time frame, all we know is that the candle opened here, it closed here, it went up to this price and down to this price. But the more we go to lower time frames, we can see more and more details of the price action. And similarly, 7 of these candles on daily time frame are just one candle on weekly time frame, or 30 of these candles are just one candle on monthly time frame. All right, now that you completely understand the differences between different time frames and how they are interrelated to each other, you may wonder, okay, which time frame should we use? Choosing of time frames depends on what kinds of a trader you are. As you saw, the more we go to lower time frames, we see more noises, and the more we go to higher time frames, the noises are removed and we see less noises and more stable situation of the price. So shorter term traders go with shorter time frames and longer term traders go with longer time frames. Let me give you a guideline on different types of traders and the time frames that are suitable for them. Generally, we have 4 kinds of trading style, which are scalping, day trading, swing trading, and position trading or long-term trading. Scalpers hold their position from as low as a minute up to few hours, depending on when the price hits their target. On average, they are in an open position for several minutes. Day traders hold their position not more than a day. They don't keep any open position overnight. And depending on when the price hits their target, it can be less than 1 hour up to several hours. And swing traders hold their positions from less than a day up to few weeks, and position traders from a few weeks to many months. Scalpers usually choose time frames from 1 minute to 15 minutes, day traders 5 minutes to 4 hours, swing traders from 1 hour to daily, and position traders usually use daily, weekly, and monthly time frame. Please pay attention that these are the most common range of time frames used by each category of traders, and as you can see, they have overlap. And please pay attention that depending on the strategy, you may also use other time frames than these. For example, there are day trading strategies that, for example, the trader watch 15 minutes and also daily time frame. This is just based on average of what time frames are commonly used by different types of traders. All right, until now, I think you can understand how traders choose time frames. For example, a scalper who is engaged in opening many positions during the day, it doesn't make sense for them to use daily time frame for discovering trade entries. For the day, there is only one candle, and there is no way you can scalp or day trade on this chart based on the current candle. But when you are on a lower time frame, for example 5 minutes, you have access to detailed price action that happened during the day, and here you can discover trade entries to enter the market. Also, on the other hand, if you're interested in position trading, it doesn't make sense to use a low time frame like this. All these price actions happen during one day, and they don't help you if you want to keep your position for several weeks, for example. Instead, you should be on a higher time frame like 4 hours or 1 day, so you can see longer term movements of the market. All those price action on 5 minutes chart are here included in this one candle, and they are just considered noise and not helpful when we want to open a longer term position. All right, now that you learned how different types of traders are categorized and what time frames are suitable for them, I want to teach you how you can analyze multiple time frames to increase the probability of finding profitable trading opportunities in the market. Multiple time frame analysis is a trading method that you monitor the same asset on different time frames. There is a general guideline for choosing multiple time frames. 3 different time frames can give you enough information about the market. Less than 3 can be insufficient, and more than 3 is unnecessary and waste of time and energy and cannot add any considerable value to the result. So 3 time frames are enough to effectively analyze the market. A very simple strategy is to use ratio of 1:4, 1:5, and 1:6, depending on if they are applicable to your trading platform. These ratios give enough room to your time frames for showing enough data of the market. Basically, 1 is your medium-term time frame, 1 short-term time frame, and 1 long-term time frame. Let me give you an example so you can better understand it. First, we start with medium-term time frame. This time frame should be matched with your trading style and also your trading strategy. Consider I am a swing trader and I want 4 hours time frame to be my main chart for analysis. So this is my medium-term time frame. Now I must choose the long-term time frame. I use ratio of 1:6, and 1 day time frame becomes my long-term time frame. And for short-term time frame, I use ratio of 1:4, and 1 hour would be my short-term time frame. So 1 1 hour, 4 hours, and 1 day time frames are the ones that I use for analyzing the chart. 4 hours time frame, the medium term time frame, is my main chart, and most of my analysis is done here. The 1 day time frame, the long term time frame, is used for identifying major trends and support and resistance levels of the market. I want to be sure that I'm in the same direction with longer term trend of the market, and I use 1 hour time frame for precise entry and exit points. Consider I have a buy signal here. As you can see, the price is apparently in an uptrend. Should I enter? No, because if I switch to my long-term time frame, which is 1 day time frame, I can see that the longer term trend is down with a downtrend line like this. Actually, the downtrend started from here. Here we had a large pullback, and again the price is going down. Here we were in an uptrend, and here we are in a downtrend. So this uptrend that we see here on 4 hours time frame, I mean here, this is just a pullback within the longer term downtrend, which we identified on 1 day time frame. And it's very probable if the price advances and reach to around here, it will stop and decline, because this downtrend line is acting like a resistance level, and we expect that we will have declining of the price if the price hit this level. So on 4 hours time frame, if we have a buy signal here, we should not enter, because our long-term time frame, on daily time frame, we are in downtrend, and this is just a pullback within that downtrend. But if we get a sell signal around here, the sell signal is confirmed by our long-term time frame, and then we can switch to 1 hour time frame, which is our short-term time frame, to find precise entry points. For example, breaking below a support level can give us a signal to enter the trade. This was an example of choosing time frames for a swing trader who is focused on 4 hours time frame, and you can do it similarly with other time frames. For example, if you're a day trader and you want to choose 15 minutes time frame as your medium term time frame, then 1 hour time frame could be your long term time frame, and 3 minutes time frame as your short term time frame. Or you can also choose 5 minutes time frame if 3 minutes is not available on your platform. There is no hard rule, and those ratios are just a guideline to help you with the time frames. In practice, all we need is 3 different time frames with enough distance from each other, but not too far, that can provide us relative information from short-term to long-term view. This method of multiple time frame analysis is called top-down analysis, because as you saw, our longer-term time frame has priority in terms of significant levels of the market. We conclude the major trends of the market or major support and resistance levels from our long-term time frame, and they have priority in compared to our mid-term time frame. And then on mid-term time frame, our strategy of finding buy sell signals is executed, and then on short-term time frame, after having a confirmed signal, we can find a precise entry point. Some traders prefer not to go to shorter time frame and they enter a position when they have a confirmed signal, but some other traders prefer to fine-tune their trade entries for maximum profit. By the help of top-down analysis, you can be sure that you are entering in the same direction of the longer-term trend of the market, not against it, so you will have significantly higher probability to have a profitable trade. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading. In this video, I want to teach you a very easy scalping strategy that is highly accurate. In this trading strategy, we have 2 indicators. The first one is machine learning Lorentzian classification. This one, which is an editor specs indicator and written by J.D. Horty. This indicator is built based on machine learning algorithm. In case if you don't know what machine learning is, it's a branch of artificial intelligence and computer science that focuses on the use of data and algorithms to imitate the way that humans learn and gradually improving its accuracy. This indicator uses a special algorithm which is called Lorentzian distance classifier, alongside with another algorithm that is named approximate nearest neighbors, which are proved to be useful in predicting direction of the future price movement. I don't get into more details regarding the algorithm behind this indicator. You can check the page of the author of this indicator on TradingView. He completely explained the algorithm, and the code is also available there, and you can more investigate if you know point scripting. All right, getting back to our trading strategy. In this strategy, we use this indicator with default settings, and our focus is only on the generated buy-sell signals. Green labels are buy signals and red labels are sell signals. The next indicator that we should add is MACD, this one, moving average convergence divergence, and we need to change the settings of this indicator. So here we go to the settings of MACD, and for the fast length we set it at 100, for the slow length we set it at 200, and for signal smoothing we set it at 50. And then we go to the style tab and we remove MACD line and signal line, because in this strategy we only need the histogram. This trading strategy is a scalping strategy, and right now we are on 5 minutes time frame. This is the price chart of euro to US dollar, but no limitation on this, and you can use this scalping strategy on any other asset or market, whether it's forex, crypto, or stock market. The only thing that we need regarding the asset or market is high trading volume and liquidity, both in terms of the asset and the broker or exchange that you're trading, because this is a scalping strategy and the profit and loss that we're going to take are very small in terms of price movement. So we don't want to experience any unreal price gap or large spread between bid and ask prices that can damage our trade entry, stop loss, and profit. So in forex market, trading on major pairs is recommended, especially euro to US dollar, or in crypto markets, Bitcoin to USDT, or in stock market, for example, Nvidia, Amazon, or other companies with very high trading volume and liquidity. Also, for scalping strategies, it's recommended to have a raw spread account, so your trading fees will be minimum and you will have greater profit per trade. All right, now let's see how we trade based on this easy and accurate scalping strategy. This MACD with the special settings that we made helps us with the overall trend of the market. When the MACD histogram is green, the trend is up and we focus only on buy signals, and when the MACD histogram is red, the trend is down and we only focus on sell signals, but we take the signal only if momentum is increasing in that direction. For example, here MACD histogram is red and we should only focus on sell signals. Here we have a sell signal, as you can see, and this sell signal is confirmed only if the bar in MACD histogram is dark red. If the bar is light red, the signal is rejected, because when it is light red, it shows that the downside momentum is weakening, but when it is dark red, it shows that downside momentum is increasing. So here the sell signal is confirmed and we can enter a short position at this point when this new candle is opened. The stop loss above the previous swing high, and profit target at 1.5 risk to reward ratio. Moving back on the chart, no more sell signal while the MACD histogram is red, and in this part the MACD histogram is green and we should focus on buy signals. Here you can see that we have a buy signal, but when this candle is closed and we have this buy signal, the bar in MACD histogram is light green. For a buy signal to be confirmed, the bar should be dark green, because when it is dark green, it shows that upside momentum is increasing, but when it is light green, it shows that upside momentum is weakening. So this buy signal here is rejected, but for this buy signal here, this is a confirmed signal because the bar is dark green. So we can enter a long position at this point when this new candle is opened. The stop loss below the previous swing low and the profit target at 1.5 risk to reward ratio. Moving back on the charts, no more buy signal while the MACD histogram is green, and here in this part the MACD histogram is red, and here we have a sell signal. This sell signal is confirmed because the bar in MACD histogram is dark red, so we can enter a short position at this point when this new candle is opened. The stop loss above the previous swing high and the profit target at 1.5 risk to reward ratio. No more sell signal around here while the MACD histogram is red, and this part the MACD histogram is green. No signal also here, and here the MACD histogram is red, and we should focus on sell signal. Here we have a sell signal, but it is rejected because the bar is light red. Another sell signal we have here. For this sell signal, the bar is dark red, so the signal is confirmed and we can enter a short position at this point when this new candle is opened. The stop loss above the previous swing high and the profit at 1.5 risk to reward ratio. Moving back on the chart, no more sell signal around here while the MACD histogram is red, and in this part the MACD histogram is green, and we have a buy signal here after this upside gap, and this is a confirmed signal because the bar is dark green. In situations like this, when you get a signal right after the gap, it's better not to enter the trade and wait for the market to cool down. Anyway, in this case, we could enter a trade and make profit because the gap didn't fill and the price advanced more. Moving back on the chart, here we have a buy signal, and this is a confirmed signal because the bar is dark green, so we can enter a long position at this point when this new candle is opened. The stop loss below the previous swing low, but in cases like this that where the previous swing low is very far from your trade entry, you can set it below the regression line, because in scalping strategies we try to set the stop loss tighter. This trade is also a profitable trade where the price advanced up to this point. Moving back on the chart, here we have another buy signal, and this is confirmed because the bar is dark green, so another long position could be opened here at this point with the stop loss below the previous swing low and the profit target at 1.5 risk to reward ratio. Moving back on the chart, another confirmed buy signal we have here, so we could enter another long position at this point with the stop loss below the previous swing low and profit target at 1.5 risk to reward ratio. Moving back on the chart, here in this part MACD histogram is red, and here we have a sell signal, and this is a confirmed signal because the bar is dark red, so we can enter a short position at this point when this new candle is opened. The stop loss above the previous swing high and the profit target at 1.5 risk to reward ratio. Moving back on the chart, here the MACD histogram is green. We have a buy signal here, and it is confirmed because the bar is dark green, so in practice we could enter a long position at this point when this new candle was opened with the stop loss below the previous swing low and profit target at 1.5 risk to reward ratio. Another opportunity for opening long position we have here, and this buy signal is also confirmed, so another long position could be open at this point with the stop loss below the previous swing low and the profit target at 1.5 risk to reward ratio. This buy signal here is not confirmed because the bar in MACD histogram is light green. Moving back on the chart, here we have another buy signal, and this is a confirmed signal because here in MACD histogram the bar is dark green, so another long position could be opened here at this point with the stop loss below the previous swing low, and this is also a profitable trade as you can see, and we continue like this. Please pay attention that although this trading strategy is very accurate, but it doesn't mean it gives you 100% guaranteed signals. No trading strategy is capable of this, and losing positions are always part of the game, and you need to manage your risk properly, otherwise you will lose your trading account sooner or later. There is a risk management strategy that is called 1% rule, and is one of the best risk management strategy for scalping and day trading. By the help of this strategy, your position size is calculated in a way that in case if the price goes against you and hitting your stop loss, you will only lose 1% of your trading account. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it, because without a proper risk management strategy, you cannot become a successful trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading. Look at this, what I did here. I added 3 EMAs with some special settings and combinations, and then I added 2 CCIs with secret settings and combinations, and then I created a very accurate trading strategy based on them. Don't worry if you're on the free version of TradingView, because I will teach you how you can have 3 moving averages and 2 CCIs on your price chart. Just make sure you watch this video until the end, and let's get started. Before we start, if you like my contents, please support the channel by liking the video and subscribing to my channel if you haven't subscribed yet. Alright, first we need to add 3 exponential moving averages to our chart with special settings and combinations. So here we click on indicators and we search ribbon. We add this one, moving average ribbon, which is a built-in indicator on TradingView platform. And now we need to change the settings. So here we go to the settings of the indicator, and here in the inputs tab, first we remove one of the moving averages, because as I said, we need 3 moving averages. The 3 of our moving averages should be exponential moving averages. So here for the first moving average, we set it at EMA. For the second one, also we set it at EMA, and for the third one, it should also be at EMA. three of these exponential moving averages should have length of 96. So here for the first EMA, we set the length at 96. For the second EMA, similarly at 96. And finally, for the third EMA, also set at 96. For the first EMA, the source of calculation should be set at high. For the second EMA, it should be set at HLC3. And for the third moving average, it should be set at low. And finally, we go to the style tab and we increase the thickness of the moving average lines so they will be better visible on our price chart. All right, we're done with the settings of our moving averages. And now we need to add two CCIs to our price chart. So here again, we click on indicators and we search multiple CCI. We add this one, which is written by Ricardo Santos. All right, this indicator automatically adds 7 CCI to your chart, but we only need 2 CCI. So here we go to the settings of the indicator and here in the style tab, we remove the extra CCIs because we don't need them. And then we go to the inputs tab and here for the first CCI we set the length at 11 and for the second CCI we set the length at 200. And then again we go to the style tab and here for the first CCI we set the color to red and we also increase the thickness of the line. And for the second CCI we set the color to yellow. And similarly, we increase the thickness of the line. And then here for overbought zone, it should be from 120 to 150. And for oversold zone, it should be from minus 120 to minus 150. And then here for the color of the zone, we increase the opacity to 70%. So they will be better visible on our price charts. All right, we're done with the settings and combinations of our indicators. And before I teach you how you can find buy-sell signals based on this, I'm proud to announce that recently I published a book, The Art of Price Action Trading, which is a complete guide to price action analysis. The link is in the description and you can get it later if you want to master price action trading. All right, getting back to our trading strategy. So here we have 3 EMAs with length of 96 with different source of calculations. And you can see that they have created a ribbon on our chart and the price is moving above and below this ribbon. And here we have 2 CCIs. The red line here is CCI with length of 11 and the yellow line here is CCI with length of 200. This ribbon and this yellow line here will help us with trends and this red and yellow line together will help us to find buy-sell signals. Let me teach you how you can do it. Let's begin with a short position setup. As I said, this ribbon helps us with trends. When the price goes below the ribbon, it tells us that probably the market is trending down. And in this case, the ribbon will act as a resistance level. When the price is below the ribbon, here we want the yellow CCI line to be below the center line. You can add a horizontal line here at 0 so you can easily track the movement of the CCI lines. This yellow CCI has length of 200 and being above or below the center line, it can tell us about trends. So we want the yellow line to be below the center line, which means that the market is trending down. So until now, we have 2 signals that the market is probably trending down. One is that the price went below the ribbon, and here the yellow CCI is below the center line. In the next step, we focus on the red line, which is a CCI with length of 34. It is moving faster and it can help us with momentum changes. We wait for the red line to go above the center line. When we have this situation, while the yellow line is below the center line and the price is also below the ribbon, this situation tells us that probably a pullback is forming on the chart. In the next step, we wait for the red line to cross back below the yellow line. When the red line is closed below the yellow line, it tells us that probably the pullback ended and the price is going to decline more. We enter a short position only if the yellow line is not oversold. In other words, the yellow line should be above this green zone. So when the red line is closed below the yellow line should be between the center line and the green zone. So here the sell signal is confirmed, and in practice we could enter a short position at this point when this new candle was opened. The stop loss above the pullback or above the zone, since it is not very far, and it would be a safer level, and profit profit target at 1.5 risk to reward ratio. I recommend when the price goes below the ribbon, you take a trade only on the first pullback, because on the next pullbacks, you will have higher risk of being at the end of the downtrend. But if you want to take a higher risk, you can also take the next pullbacks. For example, moving on the chart here, you can see that the red line went above the center line, also here, but no success for going below the yellow line. And here, after being above the center line, you can see that at this point, the red line is closed back below the yellow line, but the yellow line is already oversold. So this signal here is rejected. We don't take any trade here. Again, you can see that the red line went above the center line, and here we got the red line closed back below the yellow line, and the yellow line is between the center line and green zone. In other words, it is not oversold. So the sell signal is confirmed, and in practice we could enter a short position here with the stop loss above the pullback and risk to reward ratio of 1.5, and this was a profitable trade, as you can see. But as I mentioned earlier, to decrease your risk, it's better to focus on only on the first pullback. Here you can see that after this trade, this was the last movement of this downtrend, and then the price turned above the ribbon. All right, now let me teach you the long position setup. For a long position setup, we wait for the price to go above the ribbon, and when we have the price above the ribbon, we want the yellow line here to be above the center line. So now we have two signals that the price is probably in an uptrend. In the next step, we wait for the red line to go below the center line. This shows that probably a pullback is forming on the chart, and you can see that the price is also near the ribbon. In this situation, the ribbon is acting as a support level. In the next step, we wait for the red line to cross back above the yellow line. When the red line is closed back above the yellow line, this shows that probably the pullback ended and the price is gonna advance more. We enter a long position only if the yellow line is not overbought. In other words, the yellow line should be below the red zone. So the buy signal is confirmed only if the yellow line is between the center line and the red zone. So in practice, we could enter a long position at this point with the stop loss below the ribbon, and this is a profitable trade, as you can see. After this trade, you can see that again the red line went below the center line. Here we got the red line closed back above the yellow line. The yellow line is between the center line and the red zone. So the buy signal here is confirmed, and in practice we could enter a long position here, and this is also a profitable trade. As you can see, after this trade, you can see that again the red line went below the center line, and here at this point we got the red line closed back above the yellow line, and the yellow line you can see is not overbought. We have it between the center line and the red zone, so another long position could be opened here, and this trade is also a profitable trade. But for this one, this buy signal that we have here, this is not confirmed because you can see that the yellow line is inside the red zone, so we don't take any trade here. As I said, it's better to focus only on the first pullback, because taking the next pullbacks can put you in the risk of being in the last movement of the price and then turning of the price below the ribbon. Please pay attention that although this trading strategy is very accurate, but it doesn't mean you will not have false signals. There is no trading strategy or method with guaranteed signals, and losing positions are always part of the game, and you need to manage your risk properly. There is a risk management strategy that is called 1% rule, and is recommended by professional traders. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it, because without a proper risk management strategy, you cannot become a consistently profitable trader. All right, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.
Welcome back to another scalping lesson. Sohail here, and today I want to teach you a very powerful scalping strategy on 1 minute time frame. The first thing that we must do is setting time frame. So here we set the chart time frame on 1 minute. This is the price chart of euro to US dollar, but there is no limitation on this, and you can use this scalping strategy on any other asset or market, whether it's forex, crypto, or stocks. And this scalping